before. Can you describe how crazy it is what Fernando Alonso is doing in his early 40s?
Well, look, I mean, Fernando is a fantastic driver. He's, one of the best of all time, and he's finally got himself in a competitive car. And at 41 years of age, he's giving all the 40-somethings something to root for. And he's showed yesterday he's lost none of that racing spirit or drive or determination or skill. And he's in great shape, and he's going to be a competitive driver and team this year for us, and we've got to very much keep an eye on them, because I think they could be the dark horse of this championship.
Well, I was hoping that you'd say Ferrari, but maybe it's going to be Aston Martin. TK Ferrari just not getting it done over the weekend at all. Christian, congratulations on a dominant race weekend. I hope we can do this again soon, and please come to the studio here in New York when you make it over to the States. Christian Horner there of Red Bull Racing after a dominant race weekend.
What did we learn there?
Going forward, they really want to build out the expansion in America. Do you not get the sense of that?
Yeah, I do. They've got 3 races, I believe it is now: Austin, Miami, and Las Vegas, and it just screams LA or New York.
Well, and now the tension becomes, how do they expand into a U.S. base where you've got, basically Kardashians for racing, while also really catering to the fans? And that tension, how do you really placate the diehard fans while also dealing with U.S. insanity?
Complete amateur, but I can tell the difference between the heritage of James Garner in Monaco long ago and far away from the boulevard of Miami. To me, Miami wasn't Formula One racing.
Got to try and balance the two.
Yeah.
It's going to be difficult. It's going to be interesting to see how they do it.
I called Mayor Adams over the weekend. I said, can you fix a pothole at Lexington and 59th?
So it could be part of the
circuit. Maybe that's the way we fix the potholes here in New York City. Maybe that's how we get it done. Equity features right now in the S&P, unchanged, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, President Xi Jinping said the country will take forceful measures to support the development of high-end manufacturing. Xi spoke at the closely watched National People's Congress. China's tech industry has been hurt by U.S. trade sanctions, and big electronics assemblers are setting up more facilities outside China. China reportedly will create a new regulator to manage the country's huge stores of data. That's according to the Wall Street Journal. The journal says the agency would set data collection and sharing rules for business. It would also decide whether multinational companies can export data collected in China. Ukraine says that Russian forces are trying to cut off the besieged city of Bakhmut. The Russian attack is preventing Ukrainian troops from reaching residents who still want to evacuate. Still, analysts at the U.S.-based Institute for the Study of War says Russians will probably not be able to encircle Bakhmut anytime soon. President Biden sought to strengthen ties with black voters at a hallowed site for the 1960s civil rights movement. The president spoke in Selma, Alabama, to mark the 58th anniversary of what's known as Bloody Sunday. That was when white police attacked voting rights demonstrators. President Biden's approval rating among black voters has been falling. For the second time this year, Tesla is cutting prices. The electric car maker is reducing the base price for its Model X by $10,000 to just under $100,000. Model S will be cut by $5,000 to just under $90,000. In January, Tesla slashed prices up to 20% to boost sales. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Every day, millions of things need to get to where they're going. And at Chevron, we're working to help reduce the carbon intensity of the fuels that keep things moving. Today, we're producing renewable diesel that can be used in existing diesel tanks. And we're committed to increasing our renewable fuels production. Because as we work toward a lower carbon future, it's only human to keep moving forward.
Only at Vanguard, you're more than just an investor. You're an owner.
You got this, babe.
That means that your dreams are ours, too. And our financial planning tools can help you reach them. That's the value of ownership.
Rock, paper,
Scissors? He just played paper. He'll do it again.
No, rock. Men statistically play rock, but he played paper and lost, and the mind works in patterns. He's going scissors. know he'll go scissors, but knowing I know he knows.
Scissors, shoot. I thought we were doing rock, paper, scissors, shoot.
It's always rock, paper, scissors. If you think like a trader, we've got your back. Tasty Trade. Join the club, genius.
What do you see on the horizon? Uncertainty or opportunity? Whatever you see, at PGIM, we can help you rise to the challenges of today, when active investing and disciplined risk management are needed most. Drawing on deep expertise across the world's public and private markets in pursuit of long-term returns. PGIM, our investments shape tomorrow, today.
This is GE Vernova, helping generate and move the energy that our world needs. Welcome to a new era of energy.
There are ways to stop inflations. There are really two ways, in fact. One of them is to tighten monetary policy, but the other way, interestingly enough, is actually to let the inflation happen. By virtue of having inflation, you eventually slow down and reduce the real balances, and the consumer feels squeezed. One of the reasons why I think that we're going to see a resumption of the trend in disinflation in the U.S. is for that very reason.
Terry Wiseman, fantastic from Macquarie just last week, looking for big things to happen in Europe and calling for European economic outperformance in the year ahead. Quite a cool. Futures right now on the S&P, just about negative, just turning lower in the last 10 minutes or so. We're down 0.1% off the back of a decent weekly gain last week. In the face, some really big moves in the bond market. On the week, almost flat really on a 10-year, but still, at one point, had a look at 4% and some. Back down to 391.66 on a 10-year. On the session, Tom, down 3 basis points. Chairman Powell over the next couple of days, and then on to payrolls on Friday.
On to payrolls, but a lot of other data as well. And of course, after payrolls, we launch across the weekend, John, into the inflation report, and retail sales is out there somewhere. Are we on a recession watch? I can't figure it out right now.
Based on the data we've had so far in the US, absolutely not.
It's just gone, right?
That might change. Things could really change in the next 2 data points we get from payrolls and CPI. In just the same way things changed after the previous payrolls report. All of a sudden you get a revision and something around 200K, the conversation changes. Have some sympathy for Chairman Powell going into this testimony over the next couple of days.
Huge.
He will get a payrolls report on Friday. Then when CPI comes out next week, it's the quiet period for the Fed. So they can't come out, or they could sort of leak things to the Wall Street Journal again, but in an ideal world, they shouldn't come out and say anything at all after that CPI print, Tom, going into the Fed the week after.
We'll just have to see, but I'm going to invent a new phrase right now. We've got secular stagnation, the land of Lawrence Summers and all that. It's not stagflation. It's resilientflation. Like
that's what it's been. That's nice. That'll work. Find that on a South Side note near you.
On resilient inflation, Katia Trivedi joins us right now, head of global FX interest rate strategy, EM strategy at Goldman Sachs. Thank you so much for joining us, Dr. Trivedi. What I find fascinating here is the economic growth bolt-on to our persistent inflation. Does that surprise you?
Look, I think that our core view is still one where you're going to see economic growth resilience, as you mentioned, but some gradual disinflation over the course of the year. Now, it's true that the last releases for that have not been, very disinflationary, but I think there is a danger here that the market swings too far from one side to another, from worrying about U.S. recession risk in January to kind of no landing in February. I still think that you're likely to see a bumpy path lower in the inflation metrics, but these things are volatile. They take a few releases before you get that payback, and I think that is the real question for Chair Powell this week. Whether you get enough of the information or before the next Fed meeting.
Is dollar a movable feast? Does dollar here actually move on the surprise growth, the surprise resilience that we have?
The dollar has moved on the back of that resilience, although what I would say is that you need to take a slightly longer picture, right? I mean, if you look at the period sort of November, December, the euro appreciated on a trade-weighted basis because we re-rated European growth higher. Then we had a phase, December, Jan, where the CNY re-rated higher because we had China reopening and a pro-growth pivot there. And most recently in February, we've seen the dollar move higher because we've, got evidence of suggesting U.S. growth resilience. So when you look at any one of these things, it looks like, oh, it's just the U.S. and the U.S. is exceptional. But the reality is when you step back and look at the past 3 months, the reality is global growth is more resilient, and that's what's pushed rates up everywhere with a much more choppier backdrop for currencies.
Narrative follows price. We were talking about that at length last week, but also we heard about that from Morgan Stanley over the weekend. Andrew Sheets talking about a number of narratives that have gained traction in markets because of where the price is that they question. One of those is that inflation is as sticky and as problematic in Europe as so many people think, that the year-over-year comps are going to make inflation actually go down much more significantly in Europe than people are expecting. Do you agree with that?
Look, I think that I do agree with the broader picture, which is that, yes, I think European inflation will also, peak and decline, especially on a headline basis, given what you're seeing on the commodity price side. But I think that, this is going to be a slow process. We've come out of a period towards the end of last year where we had some, helpful inflation releases across the world. And, more recently, we've had a period where the inflation releases have been, surprising to the upside again. This thing takes time. It's going to be up and down. And in particular, core measures are going to be stickier and still end the year at levels of inflation that central banks are not going to be super comfortable with. They're going to be substantially above target. So will it decline? Yes. But is it still going to be pretty sticky and high that, central banks will want to maintain the rhetoric of higher rates for longer? I think that's still going to be with us even towards the end of the year.
But there's a question about differentials. And if you do see greater than expected disinflation in Europe, albeit at very high levels, does that mean that the euro has a lot more room to depreciate versus the dollar, where there potentially could be a stickier, less energy dependent aspect to price increases in the pace of them in the U.S.?
There's certainly that can certainly happen, but I think it also depends a little bit on what the global growth backdrop is. Typically, what we have tended to find is that in environments where growth is strong, in most parts of the world, including in Europe, the dollar tends to weaken somewhat at that point. And so really, I think that both Europe and the US are places where probably rates can stay higher for longer. I think the depreciation is more likely to come amongst jurisdictions which are likely to fall off the pace of the hikes that these two jurisdictions, the US and the euro area, are providing. So I would be more cautious on places like the UK, like Sweden, which are likely to kind of fall off that hike pace.
But Kamakshia, when you talk about a stronger dollar, and the reason why I'm focused on that, I wonder what that means for the emerging markets trade, which has been so hot so far this year. You get like a 1-2 punch where you've got China coming out overnight and saying that they're expecting a 5% below expectations for growth this year. And then potentially you could see more dollar strength than many people thought. What does that mean for this trade that so many people piled into?
I think it does mean that from the on the sort of local side of things, it is more challenging because you have the dollar moving back towards a slightly stronger level, and particularly it means that for the very, very vulnerable parts of the emerging market complex, where spreads are pretty much already at distressed levels, some of those are going to find it really challenging. We saw a huge glut of issuance from emerging markets in January, but most of that was investment grade. Amongst the high yield segment, you saw very little. You saw even, very little again in February, given the move higher in rates. And so what it tells you is that for the riskier group of emerging markets, financing conditions still remain pretty challenging and are likely to remain so for the months going forward.
Kamakshia, thank you, sir, for being with us. Kamakshia Trivedi there of Goldman Sachs on the global economy, foreign exchange. Let's talk about disinflation over at Tesla, shall we? The Model S and Model X now start at $89,990 and $99,990 in the United States, down a respective 5.3% and 9.1% respectively. More price cuts, Tom, over at Tesla.
Yeah, the whole electric thing, I think, is going to be fascinating because I'm seeing price cuts, and I'm also being told by friends they're waiting 5 years to get a car. I don't know what to think.
When I talk to car executives, they say basically Tesla got greedy and their margins were so fat. And basically now they're trying to bring down the margins a little bit and then corner the market. And that basically is the theme, that it's not necessarily because of a lack of demand. It's because they want to be the dominant player and there's so much competition that they might have to accept a slightly smaller margin, but their margins still are incredible. So I think that that's really what people are looking at.
And these price cuts may hurt their competitors more than it hurts them.
Correct. That's the thinking.
This is what Elon Musk said at Investor Day back on March 1. Tesla's Investor Day. We found that even small changes in the price have a big effect on demand. Tom, his words, very big.
Yeah, I agree with that point. And I just wonder when the brand destruction comes in where you're perceived as a lower price point car. That's got to happen at some point. It may be 1, 2, 3, 4, 5 cuts down.
We're still talking about a $90,000
exactly.
car. So, at what point is this a low-cost car?
Well, they're trying to get the cheap ones out eventually to compete with, what was it, the Nissan Leaf we decided Bramo has to have?
Yeah, I'm not sure that's the car they're competing with.
But is that the car America's going to buy? At $38,000 plus a $695 two-tone paint job.
This country's proven itself to be very reluctant about buying small cars. I mean, let's face it, when it comes to EVs and being green, for some of these cars, you'd be better off buying an internal combustion engine in a small vehicle than getting, say, the electrified Hummer. Like that's better for the environment.
But
just
it
get the
doesn't
small.
look as cool.
Precisely. So why don't they talk about that? It's not about going green. It's about looking cool
and feeling less guilty about it. How do you feel about that?
I think everyone knows. Everyone knows. Future's negative a tenth on the S&P. David Leibovitz at JP Morgan coming up next.
At Interactive Brokers, independent RIAs work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Get help reaching your goals with JP Morgan Wealth Plan, a new tool in the Chase mobile app. Use it to set and track your goals, big and small, and see how changes you make today could help put them within reach. From your first big move to retiring poolside and the other goals along the way, Wealth Plan can help you get there. JP Morgan Wealth Management.
Some things are better left to a professional.
In hindsight, probably shouldn't have tried to remove my own appendix.
Like when it comes to finding financial advisors.
What was I thinking?
So leave it to Smart Asset to find them for you. Take the free quiz at smartasset.com. Then you'll be matched with up to 3 vetted fiduciary financial advisors. To get started, take the Advisor Match quiz now at smartasset.com.
I was this close. This close.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're in this brave new world where we have more political, geopolitical risk, more fiscal, higher inflation, higher rates.
By virtue of having inflation, you eventually slow down and reduce the real balances, and the consumer feels squeezed.
There's still a lot of excess buffers in financial markets and among households.
Ultimately, it's a question whether the Fed takes the high road or the low road, proverbially and literally with rates.
If we do get to a 6% rate and have to hold at 6%, I think we're increasing the probability of a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A double dose of power coming right up. The Fed chair on Capitol Hill tomorrow and on Wednesday too. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Equity futures down by about 0.1% on the S&P. TK, we have to start in China, then make our way over to the United States. A 5% growth target out of China over the weekend.
Resilient growth target there, and resilient is the word of the day. I think I've seen it in 3 or 4 notes here. The bolt on of what happens to economic growth given all the angst of the week. Jobs, inflation, retail sales. Name the economic data. What does it do for economic growth? And what the adults are saying is resilient.
Jobs, 517,000 in America. Retail sales, a 3 handle, and inflation still too sticky. Arguably, we've said this a few times already this morning, Lisa, but for those just tuning in, arguably the best news they've had for Chairman Powell and President Lagarde is probably that modest growth target out of China.
If China isn't going gangbusters, that means that perhaps inflation isn't going to have the same kind of negative or approach for what they have to do. In other words, this could actually dampen potential inflation expectations just on virtue of nothing else on energy demand. That said, I think today is the great reset. We've had already January where it was just, gloom and doom that was just shattered, and all of a sudden people were excited about the great disinflation. And then February, everyone's worried about runaway inflation that's never going away. Have we overshot one way or another? This is the reset.
We said on this program 2 years in 2 months. I've got no idea how many decades March brings. Equity futures right now down 0.1%. Let's whip through the price action for you. In the bond market, shaping up as follows. On a US 10-year last week, a 4 handle this morning, back to 392. Some calm here, 392.84. Yield just a little bit lower, Lisa, by a couple of basis points.
Let's set up the week. It's going to be a really important week of central bank talk, of government discussions, and of course of the data. We're looking at Fed Chair Jay Powell, as John was mentioning, testifying on Capitol Hill on Tuesday and Wednesday. On Wednesday, we also get a Bank of Canada decision. And on Friday, this is going to be really interesting. It is the last Bank of Japan decision overseen by Governor Kuroda. Does he give a surprise before he leaves? Does he say to Ueda, all right, I'll throw you a bone or I'll make your life miserable? Let's see what he does. On the government side of things, President Biden is going to release his full year 2024 fiscal budget on Thursday. Very curious to see what he projects in terms of spending and how he sort of bridges some of the gaps. And then also what kind of support is provided to Ukraine. He is hosting European Commission President Ursula von der Leyen on Friday. And on the data front, we are expecting jolts on Wednesday, the job openings data. Friday's data point, John, might be one of the most important over the next couple of weeks, if not the most important. It is the report for the jobs, the employment report for the month of February. Do we see this confirm what we saw in February? If it does, how much does that change the market narrative? And if it doesn't, do we see that whipsaw back to January's disinflation? I mean, is this basically going to cause the swing in the other direction?
How big does that need to be to put 50 on the table at the next meeting, which will frustrate a lot of people because this is backward-looking data to make forward-looking assumptions about where the dot plot should be like back at the back end of 23, but you know where the conversation's going to be.
You can start normalizing and averaging out some sort of trend, which is something I know, Tom, you've been talking a lot about, the average, and all of a sudden, if you get a 400 print or something outrageous, or even a 300 print and it's not revised down, all of a sudden, you are going to have a very different conversation about how high those
I'm looking more at 3-month annualized, which is what the street's done over the years, and I think it's in vogue. You take 3 months data and annualize it. Forget about that right now. If we get surveyed, John, with no revisions on this jobs report, that's 992,000 jobs formed in 90 days, or 331,000 per month.
It's pretty phenomenal, isn't it?
It's unheard of. It's not phenomenal. It's not in the range of thinking.
And we're doing that with a Fed approaching 5%. The Federal Reserve Chair used the phrase in the last couple of months. He said the disinflationary process has started. And our next guest had something to say about that. David Leibovitz, global market strategist at JP Morgan Asset Management. David, I remember you saying it, your words. You said that phrase might go on the shelf with transitory. Has that gone on the shelf with transitory?
I think it has. I mean, when you look at the data that's come out so far this year, whether you look at the hard data being the jobs numbers, whether you look at the soft data, I mean, the survey data for February was very robust. This is clearly an economy that's proving to be more resilient than a lot of people expected, and I'm not sure that disinflation the market was really grabbing onto at the start of the year is necessarily going to come through. I mean, particularly when you look at where job growth has been most robust, where wage growth has been most robust, it's in leisure and hospitality, it's in the service sector more broadly, and the reality is that services are not really showing any signs of slowing down.
Don't talk down to leisure and hospitality. That's what we're doing right here. We're leisure and hospitality. I mean, that's what we do at Bloomberg Surveillance every day. You're in the calm, patient, long-term business. What do you say to JP Morgan clients in a panic about the people that say not only we're going to drop, but we're going to drop at some point precipitously?
So I think the first point that we've been trying to make to people is that a lot of folks are suffering from recency bias, right? When they start to get agitated, they immediately think about one of two things. They either think about 2020 or they think about 2008. Statistically, those are very much outliers. And so when we look at the fundamental data, when we look at, say, the cyclical sectors of the economy, we don't really see anything that is so far off sides that it suggests an outsized downturn when one does materialize. And so I think what we've been trying to lean on is, look, this economy has more momentum, and yes, that has implications for inflation, but if the Fed decides to crash the ship at some point down the road, we don't really see the pieces in place the way that they were, say, in 07 and 08 with respect to housing, and certainly don't foresee another global pandemic coming anytime soon.
What would it take for the Fed to crash this party?
So I think, the one thing that we've been spending a lot of time thinking about is that at the end of the day, this is really an exercise in central banks and the Fed in particular defending their credibility. I mean, the Fed can get inflation to wherever they want it to be. They can get growth to wherever they want it to be. The question is what needs to happen to rates, and more specifically, what does the terminal rate actually look like? If this is a more inflationary economy, what that means is that R star isn't 2.5%. It's probably somewhere higher, and that has implications for what the Fed needs to do in order to snuff this inflation candle out. And so, to me, the worst case scenario is a Fed that gets very frustrated with their seeming inability to get inflation back into check, and they keep hiking and hiking and hiking and throw that whole theory about leads and lags, and it takes time for this to work its way through the economy, very much into the wind. That's the big risk to the economy this year.
So how do you game out that risk in your investing? Because right now you're talking about perhaps we're not going back to another 2007, 2008 kind of crisis. So if you see resilience, that could be good for stocks, not necessarily bad, unless there is that downside risk.
Well, I think it's good short term, and I think that a lot of the concerns about profits are going to collapse by 30% that we've talked about together over the past couple of months, that's not necessarily going to come to fruition if the economy is still humming along and inflation is taking longer to come down. So I do think that near term, there is an opportunity in risk, and risk could certainly end up performing well. Again, in the short run, I think that the challenge is, how do you get inflation back in the bottle? Well, you reduce demand. And at some point that shows up in corporate revenues and corporate profits. And when earnings begin to really fall apart, that to me is what's going to lead the market back down, not necessarily to a new low, but perhaps the levels that we saw back in October and June of last year.
Do you see evidence that earnings are quote unquote falling apart?
So I think that earnings estimates are coming back down to earth, and I think that that's a good thing. The 2023 number is down, call it 7-8% so far year to date. The challenge is when you think about what the market price is off of, the market price is off of a forward multiple. So every day that we go through in 2023, we're picking up a year of average earnings in 2024 because those estimates certainly don't reflect
Where's that multiple? Where's
reality.
that statistic right now? Where's the multiple forward right now?
So the forward multiple is about 17.5, 18 times today. We think that's about 2 turns expensive relative where it should be. And furthermore, it's really a question about 2024 earnings because everybody was talking about how this was going to be a year where profits came under pressure. But if the economy is proving to more resilient, that story is getting shifted down the road. And I'm not sure that markets necessarily appreciate that. And I certainly don't think that it's in the price.
So what do you do with the frenzy of tech priced out at 22.25? Some of it's growthy, some of it's less profitable. But there's a lot of cash flow generators there as well. Are they worth that premium off 17 and 18?
So I don't think that they're there quite yet. I don't think that they're necessarily worth it yet. The reason why is that when we look around the markets today, there are plenty of other interesting things to do. I mean, the layup continues to be.
But are they value traps? This is the key question. Is John Deere or whatever trading at 9, 10, 12 times earnings, are they value traps where they sit there forever?
I only think that they're value traps if the Fed returns to zero, and I don't think that the Fed is returning to zero. I think my base case assumption is that there's going to be some sort of cost of capital in the market going forward, and that's going to make equities less about one thing, i.e., mega cap, long duration growth, and a bit more balanced like we saw in the past. I actually think businesses that can generate productivity are going to be the ones that perform best in this environment because investors aren't going to reward earnings growth simply that is a function of rising prices, right? They want to see business plans changing, and that's going to make or break investments going forward.
You say value traps, and I just think Europe. And then it feels like something's changed. Year to date, European banks, David, they're flying. What's that about?
So I think part of it is the sigh of relief trade. I mean, it's been, what, a decade since the Eurozone crisis, and Europe finally seems to be kind of shaking off its scabs and coming back into the limelight. I think part of it might be a very long overdue dead cat bounce. I also think generally there's an expectation getting baked into that market that the ECB is going to have to do more. And like the Fed, when the ECB pauses, it's going to be a pause. They're not going to turn around and cut. Generally speaking, that's just a healthier environment for the banks. And furthermore, the European banks are very different today than they were in 07 and 08, seeing much better behavior is the way I would categorize it.
What's that Disney line you used, Tom? A Whole New World.
It's a whole new world.
That's from Aladdin.
That's great.
It's a song. You never saw it.
Disney.
Yeah, I know, but you never, did you ever see it?
Why would I refer to it if I didn't know what movie it was about?
Well, I don't know. I thought maybe you were just saying it's a Disney song. It sounds like it. You know, he goes off on this.
Aladdin? Forget it. David, thank you. David Leibovitz of JP Morgan. Why would anyway?
Did you watch it?
Of course.
Do you know that song?
Yes, I watched the new one too.
Oh wow, really?
Yes.
That's devotion.
Yes.
Okay, I take it back.
Lisa, where's Lisa? I'm well researched.
You came in prepared. Okay,
of
fine.
Of course I'm prepared.
Okay.
This weekend,
we talk about things I know
we're getting
about.
ready for the Oscars, David. This weekend, Mrs. Keene is sitting there with Vet Bill on her lap, begging me to watch Top Gun new one.
Maverick.
So I'm not a tool.
It's emotional.
And
so you're not a
you're
tool?
watching Aladdin.
Watch that at the cinema.
Different kinds of things.
Yeah.
Why did I not know that?
Aladdin in the cinema?
No, the new one and the old one too. You know, the old one, the cartoon version, was in the 90s, wasn't it?
Oh, I
Early
remember
90s.
we went out with friends.
You know what the power of this is?
Big day out, that was, Bremo. Back in the day.
Let's move on. Look at those markets.
Futures down a tenth on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China has set a modest growth target, suggesting that there will be less of a boost to an ailing world economy. Beijing's goal for gross domestic product growth this year is around 5%. Economists had expected a more ambitious target following a rebound in consumer spending and industrial output. U.S. lawmakers are stepping up the push to ban TikTok. Senate Intelligence Committee Chairman Mark Warner plans to introduce a bill this week to allow the U.S. to systematically ban Chinese technology, including ByteDance's popular video service. One of the concerns is that TikTok gives China access to Americans' data. There's been a breakthrough in a long-standing feud between Japan and South Korea. The South Korean government says it would resolve a dispute over people forced to work for Japanese companies during Japan's colonization of the Korean Peninsula. The conflict has disrupted relations on everything from trade to security. A second Norfolk Southern train derailment in Ohio has Congress calling for rail safety legislation. Saturday's derailment happened outside of Springfield, Ohio. Now that's about 180 miles just west to East Palestine, and that's where a derailment spilled toxic chemicals last month. The CEO of Norfolk Southern will be questioned Thursday when he testifies before a Senate committee. And shares of Apple, they're higher today. Goldman Sachs is recommending buying Apple for the first time in almost 6 years. Goldman was mostly on the sidelines as the iPhone maker's stock more than quadrupled in value. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
It's easy to get lost in investment research. Introducing JP Morgan Personal Advisors.
Hey, David.
Connect with an advisor to create your personalized
Let's
plan.
find the right investments for your goals.
Okay, great.
JP Morgan Wealth Management.
This is GE Aerospace, advancing flight for future generations. Welcome to a new era of flight.
The first time you made a sale online was also the first time you heard of a town named
Dinosaur. We just got an order from Dinosaur, Colorado.
Start an easy-to-build, powerful website for free with a partner that always puts you first. GoDaddy, tools and support for every small business first.
Hey, Dad, I'm almost out.
I got you.
Any questions, Chris?
All good. Thanks, Maura.
Healthier is managing all your family's prescriptions in one app.
Wealth-changing question. Is your investment portfolio really customized? Some advisors say they customize them, but all they really do is ask you a few questions, then put all your money in a model portfolio. Here at Creative Planning, each of our private wealth management clients' portfolios is unique. Your investment mix will be based on your custom financial plan. If that's not how your money's managed, you're not getting the customization you deserve. Book your free meeting today at creativeplanning.com. Creative Planning, a richer way to wealth.
Change. It's the price of winning tomorrow. To adapt, you'll need trading technology that automates and scales. While our market-leading data reduces fragmentation between teams, we'll partner with you to define and deliver exactly what you need, helping you face change in ways no one else can. This is bigger thinking. This is Bloomberg for the sell side. Learn more at bloomberg.com/sell-side.
This week, Fed Chair Jay Powell testifies before Congress. First, Tuesday at 10 a.m., Powell appears before the Senate Committee on Banking, Housing, and Urban Affairs. Then, Wednesday at 10 a.m., he goes before the House Financial Services Committee. How high will rates go and for how long? Are the Fed's aggressive hikes prioritizing unemployment over workers? Are Republican threats of default justified? Tune in to Bloomberg Television and Radio each day for live coverage. Bloomberg, your global business authority.
In 2016, I declared, I am your voice. Today I add, I am your warrior. I am your justice. And for those who have been wronged and betrayed, I am your retribution. I am your retribution. We will evict Joe Biden from the White House. And we will liberate America from these villains and scoundrels once and for all.
The former President Donald Trump there over the weekend at CPAC, and not the only potential presidential candidate speaking. I say potential, he's formally in the race. This guy is not, and I would say yet. Ron DeSantis, the governor of Florida, with this to say in California on a little bit of a media tour himself. He said, we've witnessed the great American exodus from states governed by leftist politicians imposing leftist ideologies and delivering poor results. And you can see massive gains, Tom, in states like Florida, who are governing to the tried and true principles that President Reagan held dear.
Well, I saw under California and Reagan, and particularly Southern California as well. But, John, you bring up an incredibly good point. There's lots of toes in the water here. I mean, I think every candidate is putting their foot in the water. And the governor of Maryland, Governor Hogan, a moderate, I think Mr. Trump would suggest Republican in name only, he's not even going to put the foot in the water.
Well, but how do you take a local appeal and broaden it out more generally?
That's the
and with
heart of the
Ron
matter.
DeSantis
Yes.
talking to California, there was a lot of analysis about how he missed a lot of the nuance, and understandably nuance doesn't sell, but the guttural, the visceral response to just how high housing costs are in some of these states, and that the reason why people are coming to Florida is not for some political or moral indictment. But it's just more because that's where it's cheaper. It was anyway until a lot of people moved there.
Taxes, TK.
Yes.
Taxes.
Heart of the matter. Heart of the matter. I'm sorry, that's all there is to it. And some people leading this morning with the idea Mr. Biden's floating out some form of taxes. Greg Villiers tore him apart this morning in his note with AGF.
What did Greg say?
He just said it's dead on arrival. He just said the budget today and tax lift.
But aren't all these budgets dead on arrival, Tom?
Yes,
What's new about that?
And true, and in England as well, right? I mean,
the budgets usually
it's a different process.
They usually get done in the UK.
Yeah.
Parliament has a majority if you're the governing party, and then you just do it.
Let's go.
I feel aggrieved.
In our 18-month campaign,
just sort of talking points.
Whatever.
Let's try to get to August of next year. We're going to do that with Amory Horder and Bloomberg, the campaign lasts forever correspondent. Amory, I went back. I remember the story during the impeachment stuff from Dion Searcy of the New York Times, and she beautifully identified not only on the left and on the right, but in general, aggrieved America. Boy, did it sound like President Trump was speaking to his aggrieved constituencies over the weekend. How does he expand away from the aggrieved now?
Yeah, he certainly was, and that was on full display at CPAC, right? You have individuals dressed up in full-on Trump gear, holding Trump signs. Clearly, in the polls at CPAC, he was the lead winner, but others, like Governor DeSantis, was not there. He was a little bit more on a national toll. The issue right now with the Republican Party, and you have the likes of the former governor of Maryland backing out, is because it is very wide and broad, and Trump still has a strong grip on about 30%. So what the Trump campaign is thinking is if they could deflate the others, most notably the number one challenger would be, once he enters, Governor DeSantis, then they can have basically what happened in 2016, which was this huge field of some 16, 17 people that he was unable to win the plurality of. So he has that 30% grip. It's about whether or not the moderates in the party, or potentially those that are conservative, but many in the Republican Party would say don't have the baggage that Trump brings, is one of them going to be able to take
I'm going to go almost counterfactual here. I sound like Neil Ferguson, but I'm going to go there anyways. How does Haley, Pompeo, DeSantis, and the rest, how do they address with respect the GOP aggrieved?
It's a great question, and I think you're going to see them doing it in different ways. I think when you see Governor DeSantis, he really wants to make it about policy. Well, you heard him over the weekend at the Reagan Library talking about conservative policies, what he's going to do. And we have the Republican legislature kicking off this week that spans from tons of issues that he would call is really getting rid of, quote, woke education, woke capitalism in his state. He's going to go on a national tour promoting what he was able to do with this large Republican majority in Florida. So if you look at his calendar, he's going to Nevada, he's going to New Hampshire. Him and the former President Trump are both going to early state voting Iowa. So that is his take. You see, it might be a little bit more difficult for the likes of a Pompeo or a Haley to go after Trump because obviously that's their former boss. But already you see Mike Pompeo on a recent Fox News saying that he didn't actually think the former president is actually that conservative. He insinuated that because he was talking about raising of the federal deficit.
When are we going to hear about President Biden and his potential reelection campaign?
Well, it's interesting because this week Biden is going to unveil the budget. He's not just doing it from the White House. It feels almost like a campaign event because he's taking this budget unveiling with a lot of fanfare to Philadelphia. And in this, it's coming from what many expect him to announce, which could potentially be in April or in May. Basically, his wife said all they have to do is set the date. But also it's a way for him to set aside what he envisions for the country versus Republicans. Now, Greg Valliere, I read that note, Tom, this morning. He said it's a thud. It's a dead on arrival because Biden is going to propose tax increases for a lot of what he wants to do. The past Congress couldn't get tax increases done, and the Democrats held the control. But what Biden really is going to say is to America, this is my plan. I want to make sure Medicare, I want to make sure Social Security are solvent, and I want to raise taxes on the richest in this country and the corporations. Republicans, show me your budget. So it's a twofold event for Biden, but I do think it's something about him and sort of a pre-campaign event.
Are there any is there any talk about a pipeline of potential other Democratic candidates, just in case perhaps things change in a year or change in 6 months?
Well, sometimes there's whispers about this, but Senator Joe Manchin was on the Sunday shows over the weekend, and he wouldn't say whether or not he would run for 2024. There was this idea a few months back that potentially you could have this third-party candidate. Senator Manchin is up for re-election for his Senate seat in 2024. We already know that Republicans are going to heavily, aggressively campaign for that seat. But he wouldn't say also directly if he would back President Biden. So at this moment, there's not huge talk of it, but there are some fractures there. And you could see some potentially other people eyeing to get in if Biden doesn't go the full way.
Two things, message and strategy. The message, Anne-Marie, in the last election, the message was clear. He was going to try and unite the country. Some people have criticised him about the way he's governed, not in that direction. The strategy, the last time around, was just to step to the side and let President Trump make it a referendum on him. I just wonder how two things, message and strategy, will change this time for the sitting president.
Well, I think it a lot depends on who the Republican candidate is. Because if it is former President Donald Trump, some of that strategy could potentially be redone. Many individuals and polls you do see Biden still beating a Trump if it is a clear rematch of 2020. If it is a different candidate, you're correct, Jonathan. That strategy and message is going to have to change, because what the heart of the country, like the center middle, really you see from the polling of 2020 is they wanted to go back to a little bit more of a normal Washington and get rid of some of the noise. Now, if the Republicans put forward another candidate, a more moderate candidate, a Governor Sununu, a Nikki Haley, I wouldn't say he's moderate when I look at Governor DeSantis. He's definitely on the conservative side, but some of that noise and baggage he might not come with. I mean, Trump has been going after him with nicknames, and he has yet to fire back. Potentially, the Biden administration, their campaign, is really going to have to change course.
MH, thank you. Wonderful as always. Tom, it's just so early in the process. So early in the process.
It's a sanctuary here.
A sanctuary for Manchester United fans and
everybody but Red Bull, and also those just, are you kidding me? We're starting this now.
You bring up Man U. That was brutal.
Almost as bad as the Tots. The Tots were worse.
And Milan, not great.
It took you 90 minutes.
No.
I just want to say that.
No.
90 minutes.
I still, just a little bit, a flame.
Not a sanctuary.
If your business kept unemployed through the pandemic, GetRefunds.com can see if it may qualify for a payroll tax refund of up to $26,000 per employee. All it takes is 8 minutes to get started. Then, work with professionals to assist your business with its forms and submit the application. Go to GetRefunds.com to learn more.
Oh, Booking.com. I'm going to somewhere, anywhere. A beach house, a tree house. Honestly, I don't care. Hello, humidity. A fancy hotel with a sexy garden.
Landscape architect.
A tiny home with aggressive flair. Somewhere, anywhere. As long as they have childcare. Deserves a vacation.
Booking.com, Booking.
Yeah.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Team, I need a volunteer. We need promotional products.
I'm on it. 4imprint makes promotional product success easy. For high-quality items, go to 4imprint.com.
Call it 18 years at Chipotle. This was, you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
Equities look a little something like this Monday morning. Good morning to you as we kick off a new trading week and look ahead to the chairman of the Federal Reserve speaking over the next couple of days. Senate Banking Committee tomorrow, House Financial Services Committee on Wednesday. He goes twice, a double dose of the chairman. Going into that, futures negative on the S&P by not even 0.1% after a decent week of gains, up about 2% on the S&P 500 last week. Biggest weekly gain going back to January on the Nasdaq. We're just about unchanged on the Nasdaq this morning as well. In the bond market, yields look a little something like this. On a 2-year, a new cycle high last week of 4 394. Right now, about 10 basis points south of that level at 483.99. Yields in about a basis point. This curve gets even more inverted, led by the long end, the 10-year down another 3 or 4 basis points. 391.47, Tom, last week. North of 4% for the first time since November, I believe.
Can we pause? Not only with the 210, the vanilla spread, 93 basis points. I'm not in the 100 basis point watch. 20 minutes ago, a headline that is stunning. I sat in the turret of Bloomberg surveillance in 07 and 08, John, with a 5% 3-month LIBOR. And I know LIBOR is drifting away in memory, but it's still what everybody hinges off of: the loan business, all the debt business, and that. 3-month dollar LIBOR tops 5% for the first time in 16 years. That is, there's no other headline today. That is the headline that everybody, including Chairman Powell, has to adjust to.
Speaks more broadly, Tom, to what's happening with rates universally. If you think about where the 2-year was in the last week at 494, we haven't seen those levels either since 2007. Quite clearly, the Fed just hasn't been at these levels since the pre-financial crisis days.
Jerome Schneider visiting us last week, Ian Lingen, people like Ira Jersey at Bloomberg Intelligence, they know the way that all of their world is hinged to 90-day LIBOR. And that's a huge deal. It's bigger, John, than Dow 10,000. And you know how big Dow 10,000 was.
You went that far.
Thank you.
You know, because that was a big day.
It was a big day.
Oh, it's a huge day.
It's like 100 years ago.
I want to finish on foreign exchange, euro dollar, just briefly. This tug of war between what we've seen take place in the United States and this really robust data out of Europe. Eurozone inflation data last week, or CPI, all-time high. Euro dollar last week was just really, really flat. Really flat. It's like that tension through the rope of that tug of war, Bramo, on both sides, and we'll see what breaks.
Especially given the fact that inflation is a problem on both sides, is surprising to the upside on both sides. And how does that play out with respect to growth and the response mechanism within the central bank? Sticking in Europe, I wanted to take a look at Credit Suisse. We were talking earlier about David Harrow, one of the longest-standing shareholders of Harris Associates, withdrawing his full investment, selling out of Credit Suisse after holding that position for a very long time. We're seeing those shares lower by about 2.3%. And John, was reading the quote earlier, but really I just want to reiterate this. David Harrow saying we have lots of other options to invest. Why go for something that is burning capital when the rest of the sector is now generating it? And we have seen that throughout the banking sector in Europe. We're also taking a look at Apple shares. Goldman Sachs recommended buying Apple for the first time in almost 6 years, and you're seeing those shares up about 1.3%. And I think that it's interesting to see Tesla shares barely moving after cutting prices for the second time this year on a number of their models. We talked about this earlier. How much is this some sort of statement on demand and the price point? And how much is this a statement on, we want to cannibalize all your business competitors, and if we can cut a little bit, we can do it, so, go make it work.
You know that phrase, your margins, my opportunity? It's like my smaller margins, your problem. Seems to be the message from Tesla.
They don't have to go that much small. I mean, honestly, their margins are massive relative to other auto manufacturers, so they don't have to really suffer that much if they want to get perhaps a little bit more traction.
That stock not doing too much this morning. Equity futures not doing too much either. We're down about 1/10%. I imagine that might change through the week. A massive week ahead. Fed Chair Jay Powell testifying in front of the Senate on Tuesday and on the House on Wednesday ahead of the highly anticipated jobs report on Friday. Over the weekend, we heard from Mary Daly, a Tom Keaton favorite, the San Francisco Fed president.
She is.
The message basically, higher for longer. She said this: it's clear there is more work to do in order to put this episode of high inflation behind us. Tom, further policy tightening maintained for a longer time will likely be necessary.
Longer time. There's the x-axis there, and that's been the shock here of 22 into 23. Not only here, but in Europe. If you are part of America, Global Wall Street, it's time to stop and lean forward. Eric Nielsen has been at UniCredit since the advent of the Italian Republic. He joins us now, Chief Economics Advisor at UniCredit, and truly one of the great optimists on the European experiment. He nailed that coming out of the crisis of Greece and such. Eric, thank you so much for joining us today. I love your research note where you say ECB and others have it wrong. Just stop focusing on core inflation. Why is that?
Hey, Tom, good to be back. I think it's that people are way too concerned, particularly here in Europe, less so in America, but way too concerned about these inflation numbers. They are driven predominantly by the cost of energy that then has spilled through, of course, to the core numbers as they naturally do for a while, and then they come back again. It's so hard to argue in Europe that we have excess demand that drives inflation. So this is coming down again, and I worry that ECB is overreacting to it.
Do they have the policy elasticity that if the ECB, or for that matter, the Fed and others overshoot, that they can turn around and right the ship quickly?
No, they can't for two reasons. The simple one is pure pride, right? I mean, you're coming up and you say, "Oh my God, we overtime, let's turn it around." I mean, that is just a natural kind of inertia about that type of thing. But the other side of it is, remember that monetary tightening takes about at least 6-9 months and up to 18 months before it really is felt. So you're going to go into this period with high interest rates, then inflation comes down, and growth is going to slow down, and demand is being squeezed. Then they see it, unemployment goes up, and say, "Oh my God, we did too much." And then there's a pride element, then they start, and then the damage has been done before the effect of some easing comes about. So I'm very worried about that part.
So if this is a matter of pride, and if we don't see the effects of some of these rate hikes for a while longer, does that mean, from your vantage point, Eric, that you think people are overly optimistic about European growth?
Yeah, I think there is a concern about this. Admittedly, I was wrong. I thought this winter would have seen a bit of a recession, and it looks like we are skirting just short of that. But come next winter, when the full effect of the ECB tightening is going to be hit, when the excess reserve savings in the household sector is coming down, and as we see some retrenchment on the fiscal side, certainly removal of stimulus, I think the numbers will be lower than what you see by consensus and most forecasters. I'm not talking about a deep recession, but I certainly expect a lot less than is generally perceived in markets.
How could that potentially get played out in markets that could be problematic for the ECB? Namely, I'm thinking, could this make the euro weaker versus the dollar if you start to get concerned about the economic prospects, which just imports inflation and makes things a little bit more tricky?
Yeah, I think that's exactly right. I mean, it's at the end of the day, FX markets are very difficult, right, as we all know, but it is ultimately the difference between growth of the euro dollar, the growth prospect, and the carry of the interest rates, right? So certainly, yeah, you can certainly see a downside closer to parity again. I'm not in the camp who thinks we're going to go through parity, but it's probably a bit weaker from here, I could easily imagine.
Eric, in your optimism on the European experiment, you've always said they'll get along. Are they getting along with the Bundesbank now? The central nexus, Netherlands, Bundesbank, and others, what is their strength, their power now into the rest of the year?
Yeah, that's a good question, Tom. Let me start by saying I think the Bundesbank is a much more productive member of the Euro system now than it was before, where you had Jens Weidmann coming out and attacking the bank in the press. That's not helpful. And I think certainly Nagel, the Bundesbank president now, is doing this much better, more professional, and Isabel Schnabel at ECB doing a fantastic job in this. I happen to disagree with the stance, but this is something reasonable people can disagree on, I think. So I think they are too hawkish. It's very clear that it's the Northern European, it is Klaas Knot at the Dutch central bank and the Germans and some of the Northern Europeans who are driving this at this stage and have basically instilled fear in everybody because the actual inflation numbers, including core, are way too high. But we know that monetary policy shouldn't react to present numbers, and that's unfortunately what we are seeing now, also in America to some extent.
Well, Eric, to your point, they're quieter now because they're getting what they want, higher rates, Eric. And as you know, with the ECB and any central bank, it's not what we want them to do, it's what they will do. Eric, as you anticipate their next meeting, they've led us to believe they'll go 50. Do you expect them to set the stage to go 50 again at the next meeting?
Yes, I think they will. Yes, I think, John. I think the next one is 50. That's a virtually given now. I mean, they always said it, and Christine Lagarde has virtually confirmed it. Incidentally, an interesting degree of forward guidance, right? And then I think certainly in my mind, I had hoped that they would then slow it to 25, and then maybe another 25 in about 3.5. Now I think overwhelmingly likely they're going to do at least one more. So that is 2 more from here of 50. And I think a terminal point in Europe of 4% is the more likely now, unfortunately.
Eric Nielsen of UniCredit. Eric, wonderful to catch up with you, sir. As always, just brilliant on the Eurozone, the ECB, over the last few decades. Tom, Otmar Issing, speaking to Bloomberg over the weekend.
I missed this.
The former Bundesbank chief.
Yes.
He said this: I expect that we will see wage increases. We will create new inflation shocks. That's a very different take to what you heard there from Eric Nielsen.
This is profound, and just to the point that I spoke of the Bundesbank. This is classic Bundesbank. I'm going to center that around Dr. Issing. Axel Weber would be another voice along this line, and they're linking right over to, granted, there's war shock, there's pandemic shock, there's supply shock, but what you hear there is demand economics from Dr. Issing that it'll be inflation. And the key thing is LIBOR here is 5%. I just looked up German LIBOR, can't remember it exactly, it's 2.8%. That's that oomph difference between the two societies, and you get a wage spiral there with a lesser inflation.
What do you make of the Eric take on things, that we might be on the brink of making a bit of a mistake here?
I'm a big fan of Dr. Nielsen. He was legendary at Goldman Sachs running their economics, and has done a great job at UniCredit, being optimistic when people weren't. So when he says ignore core and look at other things, he's got my attention.
It's amazing, isn't it? Over the last 10 years, optimistic when people weren't, and now everyone's optimistic, and he's like, slow down. Slow down a little bit.
You know, I'm not going to mention the town he lives in because to protect his privacy, but John, he's got the big life there on the River Thames.
I know. He's got his favourite coffee shop and the Sunday note. Sounds great, doesn't it? Do you want to make that happen?
I think we should make that happen.
We should join him in his favourite coffee shop.
He's right near a brewery.
He's hiding right now.
Like you can go get a beer, not a pub.
That's perfect.
A brewery.
I know exactly where you mean.
You know exactly.
I won't say it either. Features on the S&P, unchanged. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, President Xi Jinping said the country will take forceful measures to support the development of high-end manufacturing. Xi spoke at the closely watched National People's Congress. China's tech industry has been hurt by U.S. trade sanctions, and big electronics assemblers are setting up more facilities outside China. Ukraine says that Russian forces are trying to cut off the besieged city of Bakhmut. The Russian attack is preventing Ukrainian troops from reaching residents who want to evacuate. Still, analysts at the U.S.-based Institute for the Study of War say the Russians will probably not be able to encircle Bakhmut anytime soon. Chancellor of the Exchequer Jeremy Hunt is facing a tough challenge ahead of his first budget due March 15th. UK borrowing is running well below official forecasts, but there's little room for giveaways due to weaker underlying growth. This as public service workers strike over pay and households struggle to meet living costs. Credit Suisse has lost one of its biggest backers. Harris Associates stock picker David Harrow has sold the firm's entire stake in the embattled Swiss bank. Harris Associates was one of the biggest shareholders in Credit Suisse for many years, but by the end of last year, it held only a 5% stake. Shares of Credit Suisse hit a record low last week. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Conventional thinking delivers conventional results. At Allspring, we break away with purpose. Harnessing data-driven insights and boundless curiosity. We dissect the market from every angle, helping to build portfolios that redefine what's possible. Because investing isn't one size fits all. Allspring, purposefully divergent.
You'll always remember buying your first car. But the things that last a lifetime, like happiness, love, and confidence, you can't buy those, but you can invest in them. At T. Rowe Price, our strategic investing approach can help you build the future you imagine.
Angie's List is now Angie, and it's easier than ever to get your projects done right. Inside, outside, big or small, Angie helps you find the right solution for whatever you need done. With Angie, you can connect with top local pros and see ratings and reviews. Just search or scroll to see upfront pricing on hundreds of projects. And when you book and pay through Angie, you're covered by our happiness happiness guarantee. It's easy to make your home an Angie home. Check out Angie.com today. Angie, and done.
Every day, millions of things need to get to where they're going. And at Chevron, we're working to help reduce the carbon intensity of the fuels that keep things moving. Today, we're producing renewable diesel that can be used in existing diesel tanks. And we're committed to increasing our renewable fuels production. Because as we work toward a lower carbon future, it's only human to keep moving forward.
The first time your sales reached 100K was also the first time you hit this note. Save 20% with the lowest transaction fees and keep more of what you make with a partner that always puts you first. GoDaddy, tools and support for every small business first.
This has been a problem child. We've owned this bank literally since the early 2001. And the first 10 years was a very good holding. I mean, it literally went from 20 to 60 or 70. Now, what we should have done is just sold it and that's it.
Now it's back to 2. And he doesn't own it anymore. That was David Harrow, the Deputy Chairman and CIO of International Equities at Harris Associates, speaking to Bloomberg last summer, back in August. This is what he told the Financial Times over the weekend. We have lots of other options to invest. Rising interest rates means lots of European financials are headed in the other direction. Why go for something that is burning capital when the rest of the sector is now generating it? Tom, to David's point, he's dead on. Year to date, in fact, over the last 12 months off the summer lows, European banks have absolutely ripped. And it's not just the Eurozone names. Even UBS year to date is up something like 20%. So if you're sitting there in a dog like Credit Suisse at the moment, you're wondering if you should be somewhere else. And clearly he's made that decision to make a move.
As David knows, I have memories of my Credit Suisses in my mind. You get married to a stock. There's no other polite way to put it. That's what happens. And Mr. Harrow is acclaimed. He's often on the international cycle, a top, 90th percentile performer. But the bottom line here is he maybe held it a bit too long.
Just another headline, though, that the Credit Suisse management, Tom, won't want to read this morning. A big investor like Harrow heading to the exit, the stock's down another 2%. And just to see that name, him go through the numbers there, it went from 20 to 60 or 70. Yeah. It's back down to 272 on Credit Suisse, Tom.
You may look at the financials here, and we're going to do that right now with someone hugely qualified. Jan Patrick Barnard is with Bloomberg, and we're hugely advantaged by his experience in the banking industry. Jan, I've got to ask the key question. Is there any evidence that the outflows from, in a broad sense, wealth management, asset management have slowed down? Is there true evidence of that?
That's the key point that Credit Suisse has to provide, and Harrow pointed to that fact that he's worried about the outflows to continue. And if I have to make a bet, I would say they probably will continue over the next couple of quarters, and investors will be very keen to see them to stop, not just like one quarter, but like consecutive quarters in a row to really show that confidence that Credit Suisse has stopped that bleeding and is really like making progress on the turnaround, because so far, Credit Suisse has done or showed us nothing to believe that, and that's why some investors are leaving, or big investors like Harrow are leaving the ship now.
We had just had, Jan, what we know as a dog and pony with Goldman Sachs, and as a generalization, they looked out 2 years to get to a new profit regime. When Credit Suisse now in their trauma does a dog and pony, is there any point of summed profitability?
Well, I mean, certainly the bank has still a solid business model in general. But if you remember, like when we spoke about the Lehman incident like 2 weeks ago, their client base and the business model that Credit Suisse is running after is very much based on the trust issue. And right now, Credit Suisse has done nothing to rebuild this trust either with investors or with their clients. So what they're doing is, like, as Harrow said, they're burning through capital. They're trying to keep the ship afloat. They're still doing the business that is there, but that's not enough for a share price that is so depressed to post some recovery, right? So they have to come up with some solid plan that is believable, that makes sense for investors, where they tell us, like, we are going to do A, B, C, and this is how we turn the ship around. And so far, we have seen 2 re-ramps, big announcements, lots of tra-ra, but very little substance. So that's lagging, and that needs to change.
Harris Associates used to be one of the biggest investors in Credit Suisse. It has succumbed to the Saudi National Bank in terms of leadership, or it did last year. Now we've got Qatar also at the top of the list for investors. How does the nature of different investors change the nature of the direction for Credit Suisse's management?
And that's certainly also a point that you now have two investors from the same region on board there, and they maybe have different plans for the bank going forwards. For them, maybe it's not only a money investment. Of course, at some point it has to make money, but I guess like investors from the Middle East are also like keen to use that kind of bank for doing their business in Europe and in other areas of the planet. And I mean, let's be fair, Credit Suisse still is a good name out there, and maybe like if they really want to, and if they are willing like to even like put more money in there, as we heard here, the bank is burning through capital, so at some point maybe they need more. If those investors are willing to provide that and provide the backing to the bank, maybe that can be a lifeline or some kind of a future for Credit Suisse.
Based on the profile of the investors who we are aware of now dominate, and based on what we've heard so far from management, do we have a clearer picture of what this management plans to do for its turnaround?
Well, I would say no, and that's my biggest issue with the stock. Even if it's very, very cheap on paper right now, trading on 0.2 price to book value, which is insane for a bank, and especially in this interest rate environment. But as I said, like the story, Credit Suisse has outlined some kind of a turnaround plan, but it's just lagging the details and the results, to be honest, right? And that's a big issue. So they need to deliver that first. And if we see like, let's say, 2 or 3 quarters of really like outflow stopping, a more positive sentiment towards the stock, then I would say like we can look further into the future and see how the bank can recover.
Jan, if you look at the chart back to 2009, it's upside down. It's upside down. I mean, how many names can you pick that didn't bottom in 2009 but actually topped in 2009? What kind of stock topped in 2009? And that's the chart of Credit Suisse. And Jan Patrick, the reason I bring up that chart is because surely that chart questions just the viability of the whole business model over at Credit Suisse.
Yeah, absolutely. And if you want to look at the better way to do it, you can look at UBS, for example, where they much earlier like made a clear cut and set a clear focus area of what they want to do. And Credit Suisse was always lagging that. It was always like, let's do a little bit of wealth management. Let's do also the investment banking. There was never this clear commitment to wealth management only, and we built everything around this. And that's what the stock is lagging. And I also got to say, I mean, like with a hero now leaving, it's amazing. You have an investor who stood with you through the financial crisis and says now he's leaving. I mean, that says a lot about stock market performance. It's insane.
It's just been that stock has just been so difficult. Jan Patrick, thank you,
Absolutely.
sir. Jan Patrick Barnett of Bloomberg, thank you very much. Tom, that chart's just phenomenal. How many charts look like that?
Well, we have to be careful what we say.
The top in 2009.
Oh, no, there's no other chart like it. I was just looking at the relative value function, and there's all sorts of tea leaves of compare and contrast here. But this is the spirit of it. There's a thing called institutional ownership, which is a percent of your stock owned by the big fancy people, the smart guys in the room. Goldman Sachs, 80% of their shares, John, are held by fancy people, institutional owners. Supposedly, Credit Suisse is 56%. You wonder where that'll be in the next report. But it is truly unloved out there right now.
And that's been a problem with all of Europe's banks. They look like some version of that chart. European banks do. The difference is what's happened in the last year or so, where European banks have really started to pick up with this rate hiking cycle, with this relief that Europe's not falling apart year to date, and Credit Suisse hasn't participated. And I think that's the big difference for David Herro. European banks for a decade have been dogs, and now they're not, but Credit Suisse still is. Yeah. And that's when decision time really gets that little bit bigger.
I don't have the data in front of me, but Credit Suisse's price to book is under 0.2. BNP Paribas, which is the retail giant of France, best lunch in New York, is at 0.7. And JP Morgan is well above 1, or Bank of America and the others. I mean, there's still a valuation gap there.
Is it a trap?
Well, I said that earlier to David Leibniz. He almost stood up and walked out. This is really important. I would predict, folks, in the next 90 days, you're going to see this concept of value trap among people. And one of the reasons you get out of a value trap is you own growth. Can you own growth here? is the other key question.
There's also this question of you complain about something. We've talked about this before. You complain about something for a decade about negative yields and how that's destroying your entire business model. And then all of a sudden you get rates at a level where you could potentially survive. Can you capitalize on that? Are there the people who want to borrow from you or who want to really create that dynamic to make it valuable, especially if that effectively curtails growth in the region?
Well, from a stock price perspective, exclusively, the rest of the industry is. It's rallying. Just accept this stock.
Which is the reason why David Harrow said, I understand the story for European banks because of the rising rate environment. Why should I avoid some of the ones that are going to benefit more than Credit Suisse, which is dealing with some existential questions?
That stock is down by a little more than 2%, 272. Difficult time for leadership at Credit Suisse. Difficult time for a lot of people we know at the bank as well. Just some phenomenal talent there. It just feels like a repeat of what happened with Deutsche Bank, Tom, several years ago.
Yeah.
With its differences, of course, but how do you keep on to some fantastic people that work at your bank when times are this tough?
I mean, our colleague Paul Sweeney lived this with his work at Credit Suisse, where he was definitive in media. John, I would suggest they move on to other places, and card-carrying member of that is Dominic Constant, who won the high ground for Neil Sauce at Credit Suisse, his shingles out at Mizuho right now.
Very cool. Futures unchanged on the S&P 500. Big week ahead. We'll tell you that a few more times over the next couple of days. Chairman Powell tomorrow and on Wednesday. Payrolls on Friday.
What does it mean to be ever better? It's your customers getting what they ordered when they expect it. Discover how Ryder e-commerce makes your customers' experience ever better.
Oh, Booking.com. I'm going to somewhere, anywhere. A beach house, a tree house. Honestly, I don't care.
Find the perfect vacation rental for you. Booking.com,
Yeah. This is GE Aerospace. Advancing flight for future generations. Welcome to a new era of flight.
Get help reaching your goals with JP Morgan Wealth Plan, a new tool in the Chase mobile app. Use it to set and track your goals, big and small, and see how changes you make today could help put them within reach. From your first big move to retiring poolside and the other goals along the way, Wealth Plan can help you get there. JP Morgan Wealth Management.
Hi, I'm Jeff from Nuts.com. When my grandfather started this business, he relied on freshness, quality, variety, and service. We still delivered the freshest nuts, dried fruits, snacks, and sweets to families all around the country. Nuts.com. Enjoy free shipping on your first order.
Imprint, this is Lisa. Hi, I'd like 50 welcome wows and 300 customer I love it.
Promotional products from 4imprint are certain to deliver ooh yes.
Wow.
I love it. Find some wow now at 4imprint.com. 4imprint, for certain.
The innovation agenda is going full speed on mitigation. That's where, you know, there's 100 companies Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, you know, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, you know, now 4% of new cars are electric, you know, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
DOJ or other authorities.
Could face bigger
Britain's next
was going to keep rate World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
I think the role of abundant liquidity is still critical in this market setup.
Don't necessarily be worried about liquidity conditions in the near term. There's plenty of excess reserves around in the system.
We're seeing the consumers' last stand, if you will, as households are drawing down the very last of savings. They're ramping up credit card debt.
My view is that we're going to see a slowdown in the U.S. economy in the next few months, and it will be significant.
The European economy is looking set to actually outperform the U.S. this year and next year for the first time in many, many, many years.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. We adjust, you adjust. We'll adjust with Jim Bianco here in a moment. John, we adjust with a 3-month LIBOR back to 07, 5%. That is a major, major fact.
210 spread, Tom, negative 92 basis points. This bond market
now
adjusted as well. If you're looking at the 10-year, we're down about 5 basis points on a session, 390, 3.4% last week. Just a massive week ahead of us. Chairman Powell speaks tomorrow. He's got to look ahead to payrolls on Friday, CPI next week, and come up with some kind of message to respond to the robust data we've had over the last month or so.
He's got to speak to Congress, and particularly to the House of Representatives, to the two parts of America. There is an America flat on its back of inflation. Yeah, I guess we're fully employed, but there's a huge hunk of people out there going, really, are we, with part-time work up? So he's got to handle this politically, and he's not going to talk about the elites, what they're doing at stores, all this travel malarkey we're talking about. He's got to address people struggling.
So let's talk about the Senate Banking Committee and a couple of Democrats on that committee. That's where the pushback might be. You know, unemployment's at, what, 3.4%? Really, really low, and this chairman has been upfront about causing some pain. Now, his argument is if you don't address inflation, it means even greater pain. But ultimately, Tom, will he destroy what's happening in this labor market, and is that the pushback you're going to see from the Democrats?
I would suggest it's the walkthrough going from ultra accommodative to some form of the phrase that's out there is super restrictive. And I would suggest in the last 2 weeks, the dialogue on super restrictive has massively changed. I mean, Alarian, I thought, had a very nice summation of this in the last couple of days.
We can't base it on a single month's data, but if you look at unemployment at 3.4%, payrolls at 517, retail sales at 3%, claims sub 200K, the ISM where that is right now. Can you make the argument with sufficiently restrictive?
No.
With 1 month's data, clearly not. The fact is, though, they're not just going to look at 1 month's piece of data. And a worry that I would have for Chairman Powell tomorrow, and for once actually have a little bit of sympathy for the leadership of the Federal Reserve, how can you commit to a view at the next meeting when payrolls on Friday and CPI next week could completely change the story again? You have to remember, we had 2 years in 2 months. 2 years worth of narratives in 2 months year to date, and that could change again on Friday.
You know, Lisa, I would suggest that the financialization of the system, which is what we spend all our time on, and that is secondary. In this testimony, it ends up being 900,000 jobs over the last 90 days formed, 330,000 is an average non-farm payrolls, and yet there's a lot of angst out there.
Well, this has been the line from the Federal Reserve that if you don't have stable, if you don't have price stability, you can't have a healthy labor market. So they'll talk about how they want to weaken the economy, and they're not going to say that means that we want jobs to be cut, right? This has been sort of the very difficult moment. I want to hear the balance of risks. I want him to understand and really put forward his new understanding of the balance of risks of inflation versus the prospect for a fully employed America.
I'm going to balance the risks of 2s, 10s. John pushed it out ever wider. I'm going to go to 3 digits, John. Negative 93.496. That's out to new wide inversion. The 2s dramatically higher than the 10-year yield.
Driven by the long end, though. Bigger rally at the long end today. So this is the 10-year yield falling faster than the front end. So we're down 5 basis points there, 390.49. Debate on the front end is whether we get another big rate hike from the Federal Reserve. Maybe they go 50. Conversation off that.
Really?
Jason Furman
you
in the
think
Journal.
The conversation's there? Yes,
I don't think the FOMC's there yet. I think they want to wait to see if payrolls confirms on Friday. I think it's 25 basis points. That makes sense. The closer you get to where you think terminal is, you want to move slower. Again,
Furman
that makes
made
sense.
a splash.
Furman in the Wall Street Journal says, if your reaction function is what you tell us it is, you should be talking about 50. That's the conversation from him.
Do you think he had his students write that at Ec10 at Harvard?
Possibly.
It was probably a project. I got to write a column for the Wall Street Journal. Why don't you guys write it for me?
ChatGPT.
ChatGPT.
Is that Furman's ChatGPT?
Yes, 100%.
Crowdsource.
Jason Furman in Ec10. Now, on the monetarism that we're studying right now, ChatGPT. That's it. He was there. John, what else in the data?
Hey, futures just budging a little bit higher, Tom, but not by much. It's pretty much unchanged on the S&P 500.
We'll give you the data for the week with leadership from Michael McKee. Right now, leadership from James Bianco. Jim Bianco's founder and president of Bianco Research. Jim, I'm thrilled to have you on here on a hallmark day of 3-month LIBOR at 5%. What does that signal to you?
That short rates are going to keep going higher, that the Fed at a minimum is going to be higher for longer. And the aggressive call right now is that they're going to move maybe 75 or another 100 basis points, and we could be talking about a 6 handle before the end of the year on the funds rate. But short rates are going to keep going up, and that, I think, is the big driver of why the yield curve has become a new record inversion, because it's all been driven by the long end. When the 10-year rallies, we get record inversions. When the 10-year rises in yields, we get some flattening of the yield curve, or maybe less inversion of the yield curve. And I think that story is going to continue with the bond market.
Jim, do you expect Chairman Powell will be reluctant to lean into that argument, given we're still waiting for payrolls Friday and CPI next week?
No, I don't think he will. I think that, the data, you're right. I heard you before saying, it's just 1 month of data and it's all been very, very strong. But the arc of data that we've seen over the last several months has not been weak. It has not been what Elizabeth Warren, a senator from Massachusetts, has been calling, millions of people losing their jobs. It hasn't happened. Maybe it does, but it hasn't happened yet. And a lot of people thought it would have happened by now. So I think he's probably going to stay with the more aggressive move that the Fed is going to continue to go at least 2 or 3 more rate hikes. And if you're right, if the payroll data is strong, or if the CPI data is strong, that we'll be talking about 50 for the March meeting. Right now, the market's putting about a 30% chance that the Fed will go 50 basis points at the March meeting. It wouldn't take much to push that over 50% and get people talking about it with a strong payroll number or CPI next week.
And the potential for short-term rates to go even higher is the reason why we've been talking all morning about this inversion, this yield curve inversion, the 210 spread, the most inverted going back to 1981. Some people are dismissing this and saying, you can't read too much into it. Other people are saying historically it has been one of the best indicators of recession to come. What is the correct read on this, Jim?
That a yield curve inversion is a forward indicator of recession, but more inversion does not mean a faster or harder recession than less inversion. It's a binary thing. Once you go inverted, you should be looking for a recession. Now, the thing about the yield curve is it can lead as much as 18 months before you eventually have that recession. That would put you in the first or second quarter of next year. And I think that the whole narrative around the recession, that a lot of people don't have that kind of patience. They think that the slowdown is going to happen in the next couple of months as opposed to an early 24 story. So yes, the yield curve is a very powerful signal that we might be seeing a very big slowdown in the economy, but just because it's inverting more does not mean it's going to be worse, and it could still be up to a year away.
Do you think that based on that, and based on the readjustment that we've seen in markets for the past 4 months, do you think that there is a position that seems obviously crowded amid all of this uncertainty?
Oh, that's a good one right now. I think that if there isn't a position that is very crowded in the bond market, it's definitely, higher short rates, that you've seen a lot of speculative positions and a lot of people lining up to basically make a bet that short-term interest rates, the 2-year note, the LIBOR, the Fed funds rate or whatever is going to continue to go higher. Now, the thing about those kind of overcrowded trades is those are less market-driven and more Federal Reserve policy-driven type of trades, so they can be right at times. Other than that, if you want to look for crowded trades, I'd have to, meander outside of interest rates and maybe say the reopening in China is probably on my radar as being the biggest crowded trade that we're seeing right now. Everybody's in on that trade, and with the idea that they're only pushing 5% growth for this year was a bit of a disappointment for that trade.
Jim, are you suggesting we may have seen the reopening trade play out already?
Yeah, I think so. I mean, reopening, yes, the economy is going to reopen. It's going to be stronger than it was. But this whole idea that it's going to be rip-roaring in China, that they are going to produce a ton of stuff, put it on cargo ships, send it to the U.S., and collapse goods inflation in the U.S., I think that trade is a little bit overdone right now, and there's really no evidence that any of that is going to come to pass.
Jim, wonderful to catch up with you, to get your thoughts. As always, looking forward to hearing more from you through the week as we anticipate payrolls on Friday, Chairman Powell tomorrow in front of the Senate, in front of the House on Wednesday. We often tee these things up to be big deals, Lisa, and then the individual lawmakers just try and make YouTube videos and clips to send around to their constituencies and don't ask the questions maybe Wall Street wants to hear.
So I started to look into when the last time that we got one of these hearings that was actually helpful or newsworthy.
How far back did you go?
And then I was just like, I can't do this anymore. I mean, honestly, they're never that telling, especially if they're going to go after their political message and you're not going to get the sort of real hard-hitting questions about what their direction and what their time frame and thinking is around monetary policy. So I don't know, maybe he can get away with just saying, you know, whatever you want.
It used to be that there were rules of the road. Chairman Greenspan never spoke about the U.S. dollar. That was the purview of the Treasury Department. All that was blown up, granted, for once-in-a-lifetime events. And they've got to start getting back to, I really shouldn't comment on that, blah, blah, blah. Are we going to see it? I don't think so.
I don't know how you put it back in the box, Tom.
After back
09,
in the bottle, yeah.
The demands of this central bank just went sky high. And with it, they had to introduce radical transparency. And I just don't know how you put the paste back in the tube.
Radical transparency, let's go to it right now. John, the Formula One interview we did, Christian, what was his name?
Come on.
Horner.
You've got it.
Netflix star, nailed it. People just ignored you. You spent all weekends preparing for this. I tried to ask one intelligent question. Bramo crushed it. That's the response on Twitter.
Always does crush it.
What are you talking about? Like, genuinely, what are you talking about?
Twitter, she and the Bramo offspring all weekend. F1,
Netflix.
ESPN.
Netflix or ESPN?
Watched like three seasons.
Netflix, 100% the Kardashian. The Kardashian of driving. I did watch it.
Red Bull domination. Just remarkable.
Domination. I'd never seen this, John. The leader, Verstappen, was barely on camera.
It's just gone.
They just don't even, he's just like out front.
The interesting stuff was Fernando dropping back and making his way back through the field again. But
I watched the kid from Thailand, Albon.
Yeah.
He started out like at the back and he went up like 10 levels, which I thought was, I wish they'd shown that more.
You're enjoying this, aren't you?
I'm really enjoying it. And what's fascinating, he alluded to it, Horner, the tracks are really important. Like they were all complaining Bahrain is really not that good a track.
High temperature. We'll see if he can dominate on other tracks, which essentially is what he was alluding to. Futures right now, positive 1/10 of 1%. I'm pleased we're doing this season. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. U.S. lawmakers are stepping up the push to ban TikTok. Senate Intelligence Committee Chairman Mark Warner plans to introduce a bill this week to allow the U.S. to systematically ban Chinese technology, including ByteDance's popular video service. One of the concerns is that TikTok gives China access to Americans' data. This week on Capitol Hill, Federal Reserve Chair Jerome Powell is expected to lay the groundwork for higher interest rates. Powell testifies before a Senate committee on Tuesday and a House panel on Wednesday. Fed officials are looking at raising rates several more times. That's a prospect that's making Democratic lawmakers uneasy. A second Norfolk Southern train derailment in Ohio has Congress calling for rail safety legislation. Saturday's derailment happened outside of Springfield, Ohio. That's about 180 miles west of East Palestine, where a derailment spilled toxic chemicals last month. The CEO of Norfolk Southern will be questioned Thursday when he testifies before a Senate committee. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Who would you say is the author, you or the AI?
We're seeing a rise of synthetic media, deepfakes, image filters, that kind of thing. It's becoming increasingly difficult to tell a video file which has had somebody else's face deepfaked into it. And so we got to ask ourselves, are we the author of that?
Hyundai Motor, connecting art and technology.
Rock, paper, scissors? He just played paper. He'll do it again. No, rock. scissors, shoot. I thought we were doing rock, paper, scissors, shoot.
It's always rock, paper, scissors. If you think like a trader, we've got your back. Tasty Trade. Join the club, genius.
There is more to business than the business you're in. Want smarter factories?
That's the Internet of Things business.
Accelerating R&D?
Data science business.
Okay, have a look.
Managing global supply chains?
Shrink our carbon footprint business.
That's where Deloitte comes in, with a potent blend of acumen and technology to help advance and connect all that it takes to excel in business.
To the business I'm in.
Deloitte.
When we launched the Bloomberg Terminal, it was revolutionary.
What you can do with the terminal is cutting edge, and we're constantly breaking new ground.
Our innovation challenge is to always deliver value.
From improving a workflow to deploying AI, the evolution of the terminal is constant. And it's our job to make that evolution feel seamless for our customers.
Exclusive today. JP Morgan Chase CEO Jamie Dimon sits down with Bloomberg's Ed Hammond, live from the JP Morgan Global High Yield and Leveraged Finance Conference in Miami, only on Bloomberg TV and radio.
We benefit somewhat indirectly from China because, unfortunately, the UK does not export anything like as much to China as, say, the Germans do. So in Germany, it's big news because of the exports of cars and heavy equipment. For us, it's more indirect because our actual direct trade volumes are relatively modest. So it's not great news, but I don't think we've been expecting much more, frankly. And 5% that's actually delivered would be better than a sort of bogus 8.
So Howard Davis, NatWest chairman, can I pick up on that last line? Bogus 8. I've had a message already this morning. They say it's 5. Can you believe the data that comes out of the country? Anyway, there is still that skepticism, that doubt around Chinese economic data, Lisa. It's not going away. And I would add an additional point into this as well. And we've heard this from Bill Lee, the Milken Institute. It's not just the data that you receive out of that economy. It's how certain banks cover that incoming information as well. Are you truly getting their view on things, or is that the more PR type palatable view in the mainland to make sure they can maintain a presence?
Two questions. Are they trying to generate some credibility in their numbers, or are they basically signaling that they want to de-emphasize the economy over some of the other goals? Those are some of the two questions with bringing the growth target to 5% rather than the expected 5.5%.
Is that another way of saying this might not be the end of the regulatory volatility of the last couple of years?
We've already seen it being ratcheted up from China. We've seen them go after data with a new data group, a data analysis group, basically to govern how different companies use data in China. That is really going to be one of the big questions, especially with what Xi Jinping has signaled over the past couple of months.
I like what Leland Miller said a couple of weeks ago, too, his China Beige book, where he said, look, it takes a while just to ramp up. It's much more structured in terms of the ramp up of the linkage of product and consumer. Citigroup wrote a wonderful note last week about this, as they get to 5%. It's not the cacophony that we have here, the microcosm that we have. It's much more structured and predictable, and from that is how you get to 5%.
I have to say, a legit 5 off a higher base is a tremendous figure out of China. This is the reopening story, though, so it's pretty mechanical. You go from shutdown to reopen, you should get that pop. It's the growth story of next year and the one after that people are struggling with, Tom. If you look at the consensus, it goes from 5 handle to 3, and it's that shift to 3 that you start thinking about pretty quickly, Tom, towards year end.
We'll have to see. Right now, on oil and what it will do with 5% Chinese GDP, her book is definitive, and we have her on because the book is Saudi Inc. Ellen Wald is definitive. It's senior fellow at the Atlantic Council. And what's so important about Saudi Inc. is she and we're going to Jeddah next week. John Farrell leading our charge. It is the Wald and team surveillance move to the Saudi Arabian Grand Prix as well. Ellen, I think our stereotypes of Saudi Arabia are ridiculous. I'm as guilty of this as anyone. From Riyadh to Jeddah, and the commercialism, the capitalism of the nation. How vibrant is Saudi Arabia right now?
I definitely think it's more vibrant than it has ever been. You know, my idea of Jeddah is I think about it, and you've got these, the old porches in the old town, and I think about it, from the, basically like never changed since the 1800s, but they're having a Formula One race there next week.
Oh, they are. I didn't know that. Oh, interesting, John. Let's look into that.
That's
right
a great
now.
coincidence, isn't it? That we go in 2 weeks
just
the
a
same
coincidence.
time.
And we have Ellen on at the same time to help us get to Jeddah as well. Ellen Wald, let's get serious here on China and 5%. Will that drive oil up $10 a barrel?
It could. I think what we're seeing with China is that consumer demand is returning, industrial demand is not returning as quickly, and so we're still in this kind of slower climb up. I remember when they started the reopening and everyone was anticipating this huge surge in oil demand, and I said, well, I don't know if it's going to happen quite as fast as we saw in the Western economies. I think it's going to be more of a slow climb up, and the question is really, when is that going to start hitting? And it does seem like now the consensus is not till H2, and that's when we're going to see $100 oil potentially. Of course, that hits right in the middle of the summer and potentially very high temperatures and lots of driving demand, especially in the U.S. So I do think that that's really more of where we're looking at in terms of a surge in oil prices. And of course, everyone who's predicted high oil prices, we've seen oil jump up and then go back down on recessionary fears. So I do think we're headed more in an upward trend, but there's always that potential for things to kind of wobble.
One of the most notable sort of trends over the past couple of months, Ellen, is the number of people who have just abandoned calls for $100 oil and saying, actually, you know what, it's never going to come back. This is basically where we're going to stay. I mean, it feels like the market's a bit of a child who's basically all or nothing sometimes, at least for the past couple of months. Do you get the sense that that is becoming one of the main themes, the dominant themes that you keep hearing from the people you talk with?
Yeah, I do think that we are seeing, on the whole, people kind of walking back their predictions. I remember at the end of 2022, we kept seeing, these incredible predictions. Oil is going to be 120, 130 in 2023, and now we're seeing revisions down to, well, maybe we might hit $100 a barrel. I do think that we are headed in general towards a period of tightness, of supply being more of a concern. I do think that there is potential in certain areas to increase supply to meet that demand. That the place is not necessarily the United States, though. I don't think we can depend on U.S. producers to ramp up production as much as we have in the past, and that is something that is not necessarily being reflected in the forecasts we're seeing from, say, the EIA. I do think Saudi Arabia and UAE have potential. There's also potential from Iraq, and I do think that if things get really tight, we will see OPEC moving to increase their quotas, but maybe not really until June, July, or even August.
Some people say that stockpiles have gone up and that the price has remained relatively low relative to expectations because of the increase in electric vehicle usage. Do you buy into this idea?
No. I do not.
Okay.
I think definitely we're seeing more people buy electric vehicles, but I don't think that these are that these are a main driver in stockpiles, because electric vehicles are still limited in their range. And when you look at big driving, I mean, it's not people driving an electric vehicle, 20 miles to, do some errands around town. So I really don't think we're seeing that bite. I think, if you really want to look at the big drivers in demand, we're talking about China and India. And these are not places where electric vehicles are necessarily having a huge impact. I know it looks like a big increase because when you're starting from very little and you get an increase, it's very big. But, for every EV that's sold, how many, internal combustion engine cars are still on the road and still being driven. So I don't think that is cutting demand in the places where demand is really increasing all that much. I do think that they are definitely growing in interest, but I think that there is a limit to how beneficial they are given how range-bound a lot of these vehicles are.
Looking forward to Jeddah with you. Alan Wald, the brilliant Alan Wald of the Atlantic Council, thank you. 2 weeks away, the next Grand Prix. Full F1 coverage coming up through the year. Looking forward to
Max Verstappen said this will be a different race. He made very clear in the last hour or two of the follow-up to Bahrain that it will be much closer at Saudi Arabia.
Christian Horner suggested the same thing.
Yeah.
It would be problematic, I think, for the for us neutrals or us Ferrari fans if it was
I found
more the same.
I feel like Ferrari's like the Yankees of Formula One because it's just like they always win, and so it's sort of like just rooting for the winners.
Haven't won a championship for a long time.
Oh, but they always, it's like one or two. It's
No,
like them.
a long time.
Did you were you as guilty as I was? Were you
Driving
watching?
championship? I think Kimi Räikkönen back in maybe 07, 08, something like
They're
that.
always up there. It's like the mid pack.
Were you like me yesterday? Watching
Ferrari, the Kardashians.
What?
The Ferrari, the Kardashians of Formula One.
That's right.
God, that hurts, Bramo.
Were
that
you?
Was Christian Horner, not me.
Thought
That
we
was
were
what he
mates.
said. Well, come on. They're
You know, he
beautiful.
said it was.
They're
He said it was
flashy.
Kardashian on wheels. I'm not sure he was describing Ferrari. He was describing Formula One. Okay, Dan Suzuki, Richard Bernstein of
John's leaving.
Pfizer's, Eric Knudsen of Newberger Berman, all coming up. Looking forward to that. Good stuff. Thanks, guys. Happy Monday.
You'll always remember buying your first car. But the things that last a lifetime, like happiness, love, and confidence, you can't buy those, but you can invest in them. At T. Rowe Price, our strategic investing approach can help you build the future you imagine. Get help reaching your goals with JP Morgan Wealth Plan, a new tool in the Chase mobile app. Use it to set and track your goals, big and small, and see how changes you make today could help put them within reach. From your first big move to retiring poolside and the other goals along the way, Wealth Plan can help you get there. JP Morgan Wealth Management.
Guys, help me understand something. If hair loss is one of the biggest insecurities men face and it's totally treatable, why haven't you done anything about it? Bosley, America's #1 hair restoration experts, are here to help. Bosley uses the latest technology and science to give you your real hair back permanently. That's a promise backed by the Bosley Guarantee. And right now, they've got an incredible free offer for you. If you send that text down below, they're going to give you the completely free Bosley info kit. You're also going to get a $250 free Bosley gift card. Guys, do not wait. Do not suffer the insecurity that I know that a lot of you guys are suffering with. Bosley is a solution for you at any stage of hair loss, which is something that I love. Do you think these guys are happy they went to Bosley? So guys, what are you waiting for? Go see Bosley, send the text, and get your real hair back.
For your free information kit and free gift card for $250 off, text LINE to 642-642. Ask about the Bosley Guarantee. Text LINE to 642-642.
This is Kathy. She's about to see her dentist. She's afraid. Not because of the drill, but because of the bill. A big bill. But Kathy doesn't need to be afraid, and neither do you. Thanks to affordable dental insurance from Physicians Mutual Insurance Company. It's easy to get this coverage. Don't believe me? Call or go online for all the details. You could even have this free information kit. This isn't a discount plan or preventive-only coverage. This is real dental insurance. It helps pay for over 400 procedures. That's a lot. I'm talking cleanings, fillings, crowns, bridges, root canals, even dentures. Bottom line, you'll have help paying for routine care and expensive major work. But if you want deductibles, forget it. There aren't any. No annual maximum either. Plus, you can see any dentist you want. Stop fearing the big bill. Start saving at the dentist. Call now or go to sendinfokit.com.
Physicians Mutual, Physicians Mutual.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
He's there, the kind of upside.
Bloomberg Surveillance, good morning, everyone. The beginning of an extraordinary week. I'm going to say flat out an extraordinary 10 days to launch out to that inflation report. So critical to Chairman Powell as he speaks on the Hill this week. Lisa Bramwitz and Tom King. John Farrow in preparation for the next meeting. I think he's on the phone with Ferrari.
Right being like, I'm so sorry. I don't know why she said that. Do not like the Yankees at all, I promise.
Is that her fault? We're having a lot of fun with Formula One. And, of course, there's the Formula One of the stock market, where I'm sorry, to me, the highlight here, Lisa, as we go to Gina, is the VIX 18.96. The Gloom crew just doesn't believe it. There it is. Wow.
The highlight for me was actually something that Lori Calvasina wrote in her notes, where she basically said that markets are becoming a lot less correlated, that within the indexes, you're not seeing the same kind of correlation. Individual stocks are breaking away, and you're seeing this with the flows, too. Flows are now going more into individual stocks, and they're coming out of the indexes. So are we entering kind of a new era with the discipline foisted upon the markets of money costing something? To me, that's fascinating.
The foundation to me is money's costing something, that the gravity's back in the market. In charge of gravity for the equity space at Bloomberg Intelligence is Gina Martin Adams, and joins us here after a weekend of really thinking about the markets forward. Gina, you've got a portfolio which is based on some really good quantitative, I'm going to call it black box math, over to fundamental research on value. How's your portfolio doing in this shock rally in equities?
Well, look, it's been a really interesting ride so far in 2023. Obviously, January, value was not even part of the story. This sort of momentum crash that we experienced with a rip in the non-profitable stocks certainly hurt any value-oriented investor. It wasn't anything to do with profitability and value, which are certainly key characteristics. But February's correction was really interesting because we did start to see some rationality return to markets. I only say some, though, because we still saw tech leading the recovery, and tech certainly doesn't qualify for us on a value screen. I think March will be really interesting as well, because March could be that sort of catch-all month where we really sort of right-size our expectations for Fed policy. We get a better view of what's happening with employment conditions, which have obviously whipsawed market expectations here, and we get some more rationality kind of emerge over the course of the month.
Gina, I just noticed 2-cent spread going down to new record wides, 93.4 basis points, make that 93.5 basis points of curve inversion. I've got IRA Jersey space, 3-month LIBOR at 5%. I know you and IRA aren't on speaking terms, but what does it mean to your world when LIBOR hits 5%? 3-month LIBOR hits that important mark.
What it means most essentially, Tom, is that valuation expansion is limited in the equity market. When in our broader fair value model for the S&P 500, it's really difficult for us to get to a justified multiple above 17 times earnings when we're looking at LIBOR at such extreme highs compared to recent past. So it means a lot for the equity market. It also means a lot for the equity market in a relative sense. Obviously, cash is worth a whole lot more today when you're looking at LIBOR at 5% than it was a few years ago. When we were paying nothing for cash, naturally, cash was forced into some risk-seeking behaviors, and we saw that manifest itself in enormous valuation expansion for the index. Now we're seeing the opposite occur. We characterize this as terror. There are now reasonable alternatives to stocks. Across the landscape, stocks benefited from there is no reasonable alternative for more than a decade. Now there are reasonable alternatives out there, and the result is we think your long-term return expectations for the equity market have to right-size. Our long-term fair value model says large cap stocks should be anticipated to return something like 6% average annual returns for the S&P 500 anyway, versus the 11% average annualized return we had in the post-Great Financial Crisis era.
Which is something that a lot of people have a trouble wrapping their heads around. And I want to talk about the psychology of having money cost something, and suddenly everyone who used to be a macro trader, regardless of whether they were picking stocks, have to become fundamental investors. How much are people aware of just the fact that we're not going to get necessarily a flip-flop narrative, that it's going to be perhaps this company is going to do well, this company is going to be bad, you've got to kind of figure it out?
I think investors are starting to come to terms with that, Lisa, but I wouldn't say that we're fully there, and expectations have completely normalized to this new era. Certainly, we learned a lot in 2022, but 2022 is also not necessarily representative of what to expect going forward. Correlations in the equity market spiked in 2022 because of the risk-off scenario. Now they're coming back down, but investors generally have become accustomed to this idea of if you put money into an index fund, if you put money into any form of broad equity market exposure, you're generally going to do well. To the degree that that sort of thesis was driven by very, very low interest rates, that starts to go away in an environment where interest rates are a lot higher, and suddenly idiosyncratic risks matter a whole lot more in the equity market. You probably have different segments of the equity market performing much better than others. Inflation is extremely meaningful in this climate. It didn't mean anything in the 10 years following the great financial crisis because we didn't have to contend with really any inflationary spiral or spike at all. So the investing climate has changed. I think 2022 sort of introduced us to that, but wasn't necessarily the perfect example of what to expect going forward. And that's where the risks come in, because investors can't rely on 2022 necessarily as the model. What does the model look like? And I think that our most recent example of what that model may look like is actually all the way back to 2003 to 2007, in which inflation became a general driver of stocks. The market traded with very extreme winners and very extreme losers. Dispersion was a big part of the story. Active managers generally started to do a little bit better, and value led. So you have to go back quite a ways in history to get a representative example of what to expect going forward, and that is still a challenge.
Will big tech still have a role in these indexes? I mean, how much will their role really shrink in an era characterized by money costing something?
Yeah, I think that their role has shrunk and will continue to shrink to some degree, particularly because their earnings growth outlook has been shrinking. And as long as their earnings growth outlook is less so or less strong than the broader indices, it's really difficult for tech to perform well. This is a growth-oriented sector. They've got to see that growth outlook really power returns going forward, irrespective of the economic climate, and they're not seeing it right now. This is kind of, I think, the underappreciated story of tech is, yes, interest rates play a big role, but arguably what may have played a bigger role in 2022 was the fact that earnings started to fall short relative to the rest of the market. These sort of long-term stories that really power the optimism in tech started to get dismantled. And tech needs that story, needs that earnings growth input in order to perform well.
Gina, let's talk use of cash, but not use of cash of corporations that you follow at Bloomberg Intelligence. Use of all the cash that is out there. Do we underplay the amount of cash that could go into equities worldwide because there's no other place to go?
Really interestingly, I don't think there's no other place to go, Tom, because we do think there are reasonable alternatives, and cash is now much more appealing than it used to be. That said, we do see U.S. households in particular holding an enormous amount of cash, of their assets in cash relative to recent past, and cash holdings are still rising, quite contrary to some of the popular beliefs out there. Consumers are relying more on their credit cards to fuel spending in the U.S., but they also hold a lot of cash. What typically fuels consumer investment in the equity market is actually their general optimistic sentiment about the economy. And we've naturally seen consumer sentiment depleted in an environment where inflation was so rapid, so profound. We're starting to see consumer sentiment come back. Over the course of this year, consumers are going to have to contend with what we think is likely a rising unemployment rate, even though the inflation scenario is more minimal relative to the year just past. How does that play out in consumer sentiment probably will be incredibly important to determining whether or not the consumer comes back to equities and starts to reallocate into the risky asset class.
Gina Martin Adams, thank you for the equity brief this morning before all this economic data. Martin Adams lifting the stock market with her conversation. Read on the screen earlier and right now a constructive tone. Futures up 10, Dow futures up 37, and the NASDAQ up 0.4%. I mean, there it is, 3 days in a row, just... there's a bid. I think that's what the pros say.
People want to see this market rally. It seems like there's a bit of a lift going forward. And how much is this what we heard from David Leibovitz of J.P. Morgan, where he said, you know, it's not terrible, it's not fantastic, it's not going to be the bottom that, you know, we haven't seen before. We might go back to October, but there still is enough with the earnings and companies that can muddle through with higher inflation and higher rates. And I think that that's sort of what keeps getting sussed out on the buy side.
It is March. there was February, and I believe in February, bonuses were paid. Here from Sri Natarajan at Goldman. He's among a group of top producers at Goldman whose pay has rivaled the more than $75 million awarded to Chief Executive Officer David Solomon. And he exits. This is in program trading and equities as well. A guy who's been there a long time, Joe Montesano. It's collegial, quote, he's stepping down to take a break. That sounds like what you said Friday. You know,
I'm taking a break.
I'm taking a break,
Yeah,
at least for 2 days. But there
but
it is. He's stepping down.
Yeah, I mean, look, we don't know what happened, right? He has yet to line up another job, according to Sridhar Natarajan's reporting. There has been a real desire for talent, right? The top talent is still very much bid, and we were talking about Credit Suisse and Credit Suisse First Boston. The spinoff in the U.S. is granting partner-like status, sort of like the Goldman Sachs model, to some of the people who are going to stay. So the key to incentivize the top earners, the top producers to stay clearly is in the forefront. I don't know. We'll find out what exactly happened here, or maybe we won't, but it really does highlight how much people are getting paid who are the producers.
That's the same old story. Now I'll take it over even to Asia as well, where things get tough and people pull away, and they pull away from Asia. We're leaving Asia, and then 6 months later, oh, surprise, we're back in Asia. I mean, this happens.
Yeah, well, there was another story that caught my attention this morning. Did you see that banks are starting to offer, more than 20 banks have offered 5% CD or a 4% CD. But this is what's happening, that finally certain banks, aside from the very big ones, are starting to pay up just a little bit.
End of an era right now. We're going to leave you with this as we go to a busy day with Bloomberg, with futures up 11, and all I can say is it's extraordinary. Very quickly here, Gary Rossington has died. If you do not know who that is, he is the last of Leonard Skinner. I can't convey how Southern rock changed the world years ago, of Allman Brothers, of Leonard Skinner. This is the guy, folks, who wrote Sweet Home Alabama with Atlanta Rhythm Section. They owned the major scale. They brought the major scale back to music, and they never got credit for it. Mr. Rossington, a wonderful guitar player. Stay with us, Michelle Girard, next. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Norfolk Southern has unveiled a new safety plan following a derailment last month in Ohio that spilled toxic chemicals. It will install more trackside heat detectors and explore the use of newer types of sensors to uncover axle problems. Norfolk Southern had another derailment in Ohio over the weekend. This one didn't involve hazardous materials. Ukraine says that Russian forces are trying to cut off the besieged city of Bakhmut. The Russian attack is preventing Ukrainian troops from reaching residents who want to evacuate. Still, analysts at the U.S.-based Institute for the Study of War say Russians will probably not be able to encircle Bakhmut anytime soon. For the second time this year, Tesla is cutting prices. The electric car maker is reducing the base price for its Model X by $10,000 to just under $100,000. The Model S will be cut by $5,000 to just under $90,000. In January, Tesla slashed prices up to 20% to boost sales. And cue the Tom Keene sound effects. Yes, the new Formula One racing season began over the weekend in Bahrain. Red Bull's Max Verstappen began his defense of back-to-back titles by winning the race. Formula One has become a sensation in the U.S., thanks in part to the Netflix series Drive to Survive. We spoke with Red Bull team principal Chris Warner.
We've seen massive growth. I think that the whole phenomenon through Drive to Survive has just introduced Formula One to a whole new audience, a younger audience, and very much an American audience. So I think out of the 25 new partners that we've introduced in the last 3 years, 21 of them are US-based, and 3 of them are in the Fortune 500. It's just, Formula One is on fire at the moment.
The U.S. will host 3 Formula One races this year. I'm Lisa Mateo. This is Bloomberg.
Get help reaching your goals with JP Morgan Wealth Plan, a new tool in the Chase mobile app. Use it to set and track your goals, big and small, and see how changes you make today could help put them within reach. From your first big move to retiring poolside and the other goals along the way, Wealth Plan can help you get there. JP Morgan Wealth Management.
Boss, somebody lost the list. The Angie's list. Look, so what happens to all the people that needed the list?
Wait, please. Oh yeah, everything still works. We just made it better.
So you knew about this?
Yep. Plumbers, contractors, cleaners, they're all still here. We even let you book services instantly now. Angie. I like it.
Start your home project today at Angie.com.
Today, there are more identity threats than you realize. And only one has to sneak by. LifeLock alerts you to threats you could miss. If your identity is stolen, a dedicated restoration specialist will help fix it. Backed by our $1 Million Protection Package. LifeLock. Identity theft protection starts here.
The first time you connected your website and your store was also the first time you realized
we can do anything. Cheesecake cookies?
The Chookie!
Manage all your sales from one place with a partner that always puts you first. GoDaddy. Tools and support for every small business first.
Only at Vanguard, you're more than just an investor. You're an owner. That means that your goals are ours too. And Vanguard Retirement Tools and Advice can help you get there. That's the value of ownership.
There is very much a recalibration that will go on, tightening conditions, and you might actually see some breakage at that point in time. But I also think that what you're hearing clearly from the Fed is the process which is going to be a digestive situation where they're going to digest the data. And the market has rationalized over the past few weeks, not necessarily that there's a lot of more rate hikes to come, but there's less cuts to come.
Jerome Schneider, on fire, a lengthy conversation with Mr. Schneider of the short-term market for PIMCO, really quite valuable last week. Just at least a great set of conversations last week. Mental block, I'm so sorry. Right now, there was a couple guys that were just on fire last week.
Yeah, trying to understand where we are and how far we could potentially go. This feeling that 6% now is the bogey that some people are talking about, whether we could potentially get there and what that would mean. We had a number of people saying that was likely. Oh, Porrick Garvey was terrific, yeah.
With Jerome Schneider. I thought they just really had Porrick Garvey with ING. Well, we staggered this week, and Lisa, you've lifted the market up, with your smart questions to Mr. Horner. Futures up 13. It just won't go down.
You said that Gina Martin Adams was the reason for the market to lift, so now it's me?
That's you, yeah. I got a corrective call here from Bloomberg Intelligence. I'm sorry. There's a bid to the market, over the last 3-4 days.
How much is this just directly correlated to this feeling that perhaps people got ahead of themselves with their rate hiking expectations? You're seeing it in the 2-year yield. It's come off for a couple of sessions, so it's gone lower from the peak. There isn't the same kind of hysteria about rate hikes to the moon and that perhaps this Fed and this ECB can take a breath and really take a look at the incoming data. And I think that is the feeling that you're seeing percolate into markets today.
The hysteria is not there right now. Let's use that as a segue right now into Michelle Girard, head of U.S. markets at NatWest Markets and wonderful in economics over the years. Michelle, I think that's a really, really important point. Are we getting used to higher interest rates?
Well, I think, though, the point that you both were talking about, which is that the hysteria over how high rates will go has calmed down a bit. And I think that that's right. I think it was very much, I think what's happening rightly in the market is that, as kind of in that intro was noted, it's really not so much that we think the Fed is going to be raising rates so much more than we had anticipated. We ourselves have raised our terminal rate. We do think it's probably closer to 5.75. Wouldn't rule out 6, but it's really more of the market letting go of this idea that the Fed could pivot in the middle of the year and that we'd see rate cuts at some point in the second half of the year. The Fed was pushing back pretty consistently against that idea. The market stubbornly held on to it, but with all of the strength of the data, as we saw, early in the year for January, the market is now finally, most of that has been priced out. But again, I'm not sure that we should be pricing in that we have to go to 6% or more at least at this point.
On the calendar, we have a couple of key dates coming up, starting with Friday. We get the labor market report. Some people might argue the JOLTS data that we get on Wednesday will be important as well, heading into CPI and a host of other granularities here. What are you watching most closely to understand whether this is just backward looking or whether this is an actual ongoing strength that is continuing?
Well, it certainly will be important to see in the Friday jobs data how much of a payback, so to speak, that we get. I mean, that 517,000 job gain in January obviously surprised everyone. There's a lot of debate about how much of that may have been seasonal factors, how much of that may have been due to mild weather. So the data on Friday will help give us a bit of an anchor in terms of what's really real in terms of the health of the labor market. I mean, even with a more moderate gain, we've got an increase of 175,000 forecast. You're still looking at a trend in payroll growth of over 300,000. And as you said, the JOLTS data, the claims numbers, everything does still suggest the labor market is quite healthy, quite tight. And I think that's going to keep the Fed on guard in terms of their expectation that wage inflation can pull back. And I think if you don't have an expectation that wage inflation can moderate, it's hard to feel confident you're going to get inflation all the way back down to the 2% target that you seek.
A number of the guests who we've had on today, including Lori over from RBC Capital Markets, Lori Calvasina, she was saying that even with the potential for higher rates, markets are already pricing a lot of that in, and they're seeing a lot of strength from the increased demand, from the strength in people's wages. Do you agree? Are you leading into risk? Because right now, a lot of these companies and a lot of these consumers are able to handle rates where they are.
Well, I think that that's true in the sense that I think the market is pretty well priced for what I think is appropriate in terms of the interest rate outlook, given what we know now. The economy for sure has shown resilience. I do think that some of this has been, again, this excess savings that have continued to sort of bolster consumer spending, making it easier to sort of tolerate higher interest rates. We've also actually seen, with the strength in the labor market, we've seen real gains in the wages in terms of wage increases have outpaced inflation over the last few months. So there is support for the consumer. That said, we do think over the second half of this year, you are going to see the consumer pause. We actually still have a recession in our forecast. So I don't think that we've been able to avoid what I think will ultimately the impact of these higher interest rates from the Fed.
Michelle, you have a wonderful grounding in what I'm going to call freshwater economics and even Midwest economics, if you will. Is the chairman a slave to theories from another time which don't work coming out of a pandemic?
That's a great question, Tom. I don't think that the chairman is a slave, to sort of what always has been. I mean, I think that there are some very fundamental rules which still apply. I mean, I think when you've got healthy demand, an economy that is growing above trend, and you've got inflation higher than you want, it's hard to anticipate that inflation is going to come down. So I think that, kind of operating in the same sort of general way that you've approached, monetary policy for the last 100 years isn't wrong. But I also do think that the chairman and the Fed have been open to recognizing that in the unprecedented events of the pandemic and all that followed, they don't know. And I think that this is why they're trying to sort of feel their way along. They are a bit data dependent. I think they're hesitant to be as forward looking as they might normally be inclined to be, because they acknowledge that there is just so much uncertainty now in terms of being able to really assess if the world is exactly working in the way that it always has.
Michelle Gerard, thank you so much. With NatWest Markets, they're a brief here. We've got a couple of these today, folks. Good economic briefs before all of this data. I'm looking at, folks, we have the ECO Go screen. None of this is original. I got nothing original to say. McKee just says, Tom, go ECO Go and you'll pretend you're smart. So we got factory orders today and durable goods and that, Lisa, and we go on, and I don't think we're talking enough about the microdata, not ADP. Nobody has a clue about that. But what do we do with initial jobless claims? We got it wrong last 5, and I'm sorry, it's still fully employed America.
Well, and this is a reason why JOLTS is taking on new importance. Even though a lot of people have said that this is perhaps not a relevant statistic, but even if the companies are posting fewer jobs, that could possibly indicate there is a softening in the hiring, albeit not necessarily the firing, because that would be the unemployment benefits that people would be filing for. I think what Michelle was saying there was really important about the payback from the previous month. Do we see the payback that we didn't see last month, and that sort of revises that 500 level to rethink that perhaps we are seeing some sort of moderation?
Well, do you get the 3-month moving average to go from the survey of 330,000 maybe down under 300,000? That would be a start. How about March 15th, off our radar, the day after CPI, there's a retail sales report. And it's gloomy. I mean, I'm looking. We don't need to go into the numbers now, folks, because they're going to change before we get to the 15th.
100%.
But the answer is, it's a gloomy expectation out there in the market. Futures up 9 keeps saying it's just not that gloomy.
Yeah, well, that's basically what I was going to say, is that they've been glooming expectations for a while, and every time they've come in gangbusters. I mean, one data point after another. If you look at the economic surprise index, it's the most positive it's been for a long time in the U.S., and you could see this as a trend throughout. So I don't know. I don't know what to make of this, and how do you put this mush together and then still hold true to some sort of theory that you just, you know, they're going to be lag and long
and I know NBER has got a whole series. John Podesta has a whole series of papers on mush over at NBER, and the answer is, out of a pandemic, that's what you have.
How long do we have a mush?
It's probably accurate.
How long do we have to have a mush? I mean, this is the question.
Formula One, did we embarrass Pharaoh?
I don't know. I don't know. He hasn't come back yet, so we'll see whether he comes back tomorrow.
He and Mr. Horner are talking about bars and restaurants in Coventry or something.
Yeah. Well, you know, we're tourists.
We are tourists.
We're the new upcoming audience.
Don't be a tourist. Stay with us on radio and television today. Mr. Diamond, the 11 o'clock hour.
What do you get from the Morgan Stanley client experience? Listening more than talking, and a personalized plan to guide you through a changing world.
For the third consecutive year, the number of hedge funds on Interactive Brokers platform increased at a higher rate than any other leading bank or broker. Interactive Brokers serves both organizations and individual investors. To get better results, switch to a better platform. The best informed investors choose Interactive Brokers.
If you're watching this Gerber Life Guaranteed Life Insurance commercial, there's a good chance that you're alive. And if you're not, well, this may not be of interest to you. Now, I know what you're thinking. Life insurance? I'm going to live forever. Death is what happens to other people. Well, for the sake of argument, let's assume you're wrong, and that someday you won't be watching TV anymore. I know, it's not easy to talk about, so I'll do the talking. If you're 50 plus and alive, you can apply for Gerber Life Guaranteed Life Insurance with guaranteed acceptance, regardless of your health. And since this life insurance is guaranteed, you don't have to get a medical exam. In fact, you don't even have to fill out a health questionnaire. For a free quote, just call 800-600-8907. Then when you stop, if you stop watching TV, your family can use the insurance money to help cover your final expenses or anything else. For a free quote, call today, 800-600-8907. Your kids already inherited your ears, allergies, and questionable singing voice. Don't make them inherit your final expense tab too.
Team, I need a volunteer. We need promotional products.
I'm on it. 4imprint makes promotional product success easy. For high-quality items, go to 4imprint.com. 4imprint, for certain.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound.
Okay.
I think the way they got a date was to impress the females by making loud booms.
Let's get the week started. Live from New York City this morning. Good morning, good morning. Equity futures positive 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Chair Powell and payrolls just around the corner. China's growth target disappoints big expectations, and Credit Suisse losing one of its biggest backers. We begin with the big issue, a market-defining week.
We have the payrolls report on the 10th. Non-farm payrolls, a big important print.
Chair Powell this week.
Chairman Powell will appear in front of the Senate Banking on Tuesday and then House Financial Services on Wednesday.
I think they'll stick to the script.
We expect him to deliver, the messages that he has been.
We still have a high inflation environment.
He will underscore the fact that inflation continues to be their main objective.
Whether you get enough of the information or before the next Fed meeting.
What actually happens in terms of the questioning of Powell is another thing.
We just have to see how the data develops.
We've got key data coming up.
We're certainly all beholden to the data at this point.
The proof is going to be in the pudding.
The Fed is data dependent. We are data dependent. The market is data dependent.
We are data dependent. Joining us now is Neuberger Berman's Eric Knudsen, Dan Suzuki of RB Advisors. Gents, to the both of you, thanks for being with us. Eric, I want to begin with you. Jason Furman in the Wall Street Journal suggesting we should go 50 at the March meeting. Do you agree?
No, I think the Fed can stay on the track they're on, 2-3 more 25 basis point hikes, and then continue to watch the situation unfold. I think that a 50 basis point hike would show a level of kind of concern, potentially panic, that would potentially frustrate markets at this point. And they don't need to add volatility in the system. There's going to be plenty of volatility associated with short-term data.
Dan, I won't bury the lead. You say people are way too focused on the Fed. Why is that, Dan?
Yeah, I think, John, the Fed was the story of last year, right? The market was mispricing inflation, mispricing the Fed. I think a lot of that heavy lifting's been done. So, all those clips that you just played about the Fed being data dependent, I think we got to recognize that the Fed at this point is not in the driver's seat. The Fed is going to respond, to the macro data, and ultimately it's going to be growth. So if you think that growth is going to slow, that's going to determine what happens to rates, the Fed, earnings, et cetera. Conversely, if you're bullish on growth, you should think that rates are going to go higher. So I think that's going to be the ultimate driver of things. And we think, at least on the data we see now, that growth is going to slow.
Well, let's talk more about that data. I've said a few times, we've had 2 years worth of narratives in 2 months, January and February. When you get to March 14th, that CPI print, and you get to 8:31 Eastern time, does that narrative switch back again?
It could. I don't think it's going to change in a big way. I think that, the market is intensely focused on sort of what the Fed has outlined as their focus, which is sort of services, non-ex-shelter. And I think it doesn't look like you're going to see any big change there. So I think, we have to recognize that inflation has shifted from, the leading volatile components now to the lagging sticky components. And the fact that they're sticky and lagging means that they're probably going to be with us for a while, and you're not going to see a dramatic fall off anytime soon, especially with the labor market as tight as it is. So I think, that's not going to be a big game changer in my mind.
Eric, how do you think the chairman's going to approach some of this later this week, tomorrow in front of the Senate, in front of the House on Wednesday, ahead of payrolls on Friday and CPI next week?
Yeah, he's going to continue to try and walk the tightrope that he's been on. With the gradual increase in rates now, the moderate and measured pace while they wait for the data to unfold. I completely agree with our other panelists that the Fed being data dependent is now reactive, given that monetary policy works with significant lags. And the risks in terms of what's priced into the market are really around inflation being higher than what's priced, and also that growth is slower than what's priced in the market, and that's what we're focused on.
Well, let's talk about what's priced right now in the rates curve. Dan Suzuki, it's about 540 as a peak rate. Late summer, September. Would you take the under?
Jonathan, I think maybe I take the under, but I don't think it really matters really that much. I think the Fed is more or less, fairly priced into markets here. So at this point, whether it surprises to the upside or to the downside by 20, 25 or 50 basis points, I think that's missing the point. I think that more or less, that doesn't really change the fundamental story. So then the fundamental story is going to come down to, if it's not going to be the surprise coming from the Fed and where interest rates are, I think it's going to be ultimately earnings growth. I think that, has more risks than the market's giving it credit for.
Well, Dan, I think JP Morgan agree with you. Mislav Matejka writing this morning that their core view is that the current activity upswing is unlikely to develop into a fully fledged acceleration in the second half. They're advising their clients, they're advocating for a reduction in exposure off the back of this Q1 strength. Something you're discussing, though, Dan, I think is important here. There can be a difference between what the economy does and what you can already see in earnings. How big is that divide right now currently for you?
Oh, it's huge. It's huge. If you think about, the economy, remember that when you buy the stock market, you're not buying GDP, you're buying corporate profits. And there's a huge disconnect because if you think about the economy, it's just got a lot more supports and ballast right now. The economy, as we all know, is, much more consumer and household driven. You think about the household, you think about the consumer, it's buoyed by the tightest labor market in decades. It's buoyed by, the excess savings that they built up and strong balance sheets. It's buoyed by the fact that gas prices have come down a lot, and until recently, mortgage rates are coming down. So all these things are very, very supportive of the household and the economy. But the debate is out the window when it comes to corporate profits because we're already in a corporate profits recession, and that's the bigger important indicator for the markets.
Mike McKee, we get another look at the labour market, that tight labour market, a little bit later this week. Before we get there, Mike, we've got to talk about Chairman Powell on Capitol Hill.
Yeah, I think Dan Suzuki put it very, very well about where the economy is now. You take a look at a picture being worth 1,000 words. Take a look at a chart of where we are at the moment with inflation and the Fed. Inflation was coming down as the Fed raised rates, and then all of a sudden that progress has stalled out. You can see the yellow line there. That's where the market thinks the Fed is going to have to go. And historically, the Fed has always had to go above the inflation rate in order to achieve its goals. So then the question becomes, as Jay Powell heads to Capitol Hill, how far do they go? They're going to release a new forecast, a new dot plot on March 22nd. But does he give us any hints about how high that's going to be? Right now, 5.1% is the consensus terminal rate. How much above that will the Fed go? Will he put that 50 basis point move on the March table? Some members have talked about it. A lot of people leaning against it, but that may be dependent on the data later this week. What does he say about the unemployment rate? You can bet that Elizabeth Warren and perhaps some others are going to give him a hard time about the idea of raising the unemployment rate, putting people out of work in order to bring inflation down. And then what kind of fiscal policy questions does he dodge, and how? He's going to be asked about the debt limit and perhaps the idea of a government shutdown, also bank capital requirements. There are a lot of things out there that are not going to be number one on the list for the markets. But here's the thing, and you mentioned this. We have Powell on Tuesday and Wednesday. Wednesday, we also get the JOLTS report. It's for January. It'll tell us how many job openings there are. There are questions about how accurate it is, but that's been what the Fed has hung its strong labor market view on. So we'll get that report just before he testifies, and then Friday after he testifies, the February jobs report. So I think right now you really can't say what the result of Powell's testimony is going to be for the markets until we get that number, and of course, as you pointed out, get the CPI the following week, because a data-dependent Fed has to have the data.
Well, Mike, let's talk about that data and go through the calendar together. You've mentioned Chairman Powell's 2 appearances this week on Capitol Hill. Payrolls on Friday, CPI next week on the 14th. Mike, do you think it's significant that the CPI print drops in the quiet period for Fed speakers, just in terms of how they might tailor their message this week?
Well, it's significant in the sense that it makes it more difficult for both the Fed in sending a message, although they can pretty much stick to their script so far of higher for longer, but we don't tell you how much. It really makes it difficult for the markets because they're going to be trying to guess what the Fed is thinking about the CPI report. And if we get a significant move one way or the other, it's definitely going to affect where people think the markets are going to have to be on March 22nd.
The option, of course, still available just to kind of leak the decision ahead of time, Mike, but we won't go there again. Mike McKee, thank you, sir, as always. I'm sure you all know what I'm talking about at home. Here's one take on things right now. Is good news just good news? This is Stuart Kaiser of Citi. He says we remain in the camp that good growth is good for stocks, particularly against the backdrop of slightly higher inflation data of late. Here's the projections from the economics team over at Citi for what they expect on payrolls. 255 this Friday, 0.4% average hourly earnings, and Chairman Powell to leave all options open but indicate a preference for 25 basis points. That mix, according to Stuart Kaiser, would be a net modest positive for equities. Eric Knudsen, is good growth good for stocks?
Well, generally, yes, of course, but if good growth means that rates are going to be higher and for longer, then ultimately that has to get priced into equities. And so far this year, we've seen rates rise. We've finally seen the market kind of line up with the Fed dots, and yet you haven't seen that have an impact on corporate, on PEs, where PEs have actually gone up over that time period. And not just that, but the best performing stocks have been the growth stocks, the longer duration assets. And we think that that needs to start to shift. That earnings quality is at a secular low in the S&P 500, and that's true in Europe as well. And that as investors begin to realize that rates are going to be higher for longer, even if the economy is reasonably good, they're going to have to start repricing equities to reflect that our earnings growth is going to be coming down. It's already come down somewhat, and that you need to discount those future earnings at a higher level. That leads us to more value stocks, high quality stocks, higher income stocks, and less into the long duration portion of the equity market.
Well, Eric, let's go through your US equity views right now. I've got large caps underweight, small and mid caps underweight. You mentioned what you did like. Which industry groups do you like at the moment?
Well, we want, as I mentioned, we want to be oriented towards the highest quality names from an earnings quality standpoint. We want to be biased towards lower beta names. We want to be biased towards quality value names and higher dividend yielding names. So that keeps us out of, some of the more speculative areas of technology, the more richly valued growth areas of the market. And then finally, we do think that there will be a demand for commodities, and so we do still like energy and materials within the context of the overall quality value theme.
Well, Eric, to your point, you don't like tech. Dan Suzuki, you don't like tech at all. Has that view changed?
No, not at all, Jonathan. I think, in fact, with NASDAQ getting close to where it was a year ago in terms of valuations, I think the risk war has actually gotten worse. So I think, we've talked about this many times in the past. Bear markets always signal a change in leadership. We've had the signal. I don't think that they're going to be the leadership, and it's still the most expensive part of the market, yet has some of the worst earnings growth out there. So I think that combination is never an attractive combination. I think there's much more attractive areas, both for the near term and the long term, if you move outside of tech.
And outside of the United States maybe as well. We're going to talk about that in a moment. Dan Suzuki, Eric Knudsen sticking with us. Equity futures right now up 0.2% with some movers going into the opening bell. Here's Abby.
Hey, John. Well, we are looking at the possibility of 3 up days in a row, the first time that we'll have seen that in more than a month. And a big piece of it, Apple. Apple is popping, of course, as Goldman Sachs is positive on the shares. A new analyst is in town for Goldman Sachs. And the first time that they're putting a new buy rating on this stock in 6 years. This analyst is saying that the company's large user base for the iPhone will help them expand its services business. They're looking at a price target of $199, suggesting that there could be more than 30% upside. Sienna having its best day since December of last year, up nearly 12%, a very strong quarter, an 80% beat on the bottom line. They also beat sales by about 10%, putting that number above $1 billion on the quarter. And they're seeing now greater than 20% growth for revenues in the current year. Investors liking it. Again, that stock up sharply. And then finally, Merck up about 0.6%. It has a new buy rating at Jefferies on valuation, plus the analyst at Jefferies saying that the street may be mismodeling its key cancer drug, Keytruda. This analyst and Jefferies sees 17% upside for the shares of Merck, up a little bit this morning, John.
Abby, thanks for that. The broader market just about positive. Coming up, China setting a 5% growth target.
It's not great news, but I don't think we'd been expecting much more, frankly. And 5% that's actually delivered would be better than a sort of bogus 8.
That conversation up next.
Countdown to the opening bell is brought to you by Crypto.com, the world's fastest growing crypto app.
You'll always remember buying your first car. But the things that last a lifetime, like happiness, love, and confidence, you can't buy those, but you can invest in them. At T. Rowe Price, our strategic investing approach can help you build the future you imagine.
Think he's posting about all that ancient Roman coinage? No. He's making real-time money moves with Merrill. So no matter what the market's doing, he's ready. And that's how you collect coins.
Your money never stops working for you with Merrill, a Bank of America company.
I think the vision that I would like to share is one that pictures humanity more holistically. I wanted to challenge the idea of the digital and what is being left out. Machine learning can be mobilized to sort of understand that better, understand our humanity, the ways in which we exist in the world.
Hyundai Motor, connecting art and technology.
What happens when uncertainty is less uncertain? Essential intelligence from S&P Global empowers you with the information and guidance to easily navigate potential risk. Because when you have the tools to do more than simply manage risk, there's no opportunity you can't seize. A better future awaits. It's yours for the seeking. S&P Global. Seek and prosper.
You could manufacture a whole new way of manufacturing. You could disrupt buying habits before they disrupt your business. You could fire up a new generation of startups and fuel the search for what comes next. So, what are you waiting for? Go. Baker Tilly.
There will be a recovery in China relative to what we've seen over the last year. And so whether that's 5% or close about to that figure, for markets, it still will be a recovery. You do need policy support. You need the consumer to be supported. But we are seeing angles of those pan out in policies.
China setting one of its lowest growth targets in decades. The announcement coming as the nation kicks off its annual National People's Congress. The outgoing Premier, Li Keqiang, saying, quote, "We are confident and capable of ensuring the implementation of policies to promote consumption this year so that it will make a greater contribution to achieving the GDP growth target of around 5%. Bloomberg's Damien Sasser joins us now for more. Damien, I've heard some people call that disappointing.
Yeah.
What's your take?
Well, I mean, 5 is the new 5.5%, down from 7% in 2013 when Wen Jiabao was last in power, right? And so obviously growth targets have come in. In China, you're looking for now 5% with 3% inflation. Nothing's really changed. I mean, that was kind of the target going into last year, although we underperformed. We came in at 3% full year. I mean, Jonathan, again, this kind of speaks to the fact that Beijing is trying to prepare the markets that this is not going to be a hard and fast reopening. It's going to be slow, it's going to be methodical, and it's going to take all year until the housing market comes back and we really see the consumption at households really kind of snap back, which is what this economy needs to hit that target.
Damien, there was a question over the weekend as to whether this more modest growth target opens the door to the reintroduction of the so-called Xi regulatory volatility. Yeah. What do you make of that?
Yeah, no, I mean, I think there is going to be a lot of uncertainty surrounding how, I mean, look, just what the topics in Party Congress, the fact that they want private enterprise to be more party-oriented. You know, there's a lot of that talk going on. Just the fact that all the new people in power are not nearly as market-friendly as those who are outgoing just speaks to, in volumes, to what she has planned over the course of 2023. But again, you know, and you have to ask Dan Suzuki this, I'm sorry, but, you know, Dan's a fan of Chinese equities because of all the markets globally, Jonathan, that are entering a profit recession. China may be that one economy that's exiting it. So, you know, there are some places in China that investors are indeed looking at here.
You've already picked out my first question, but before I get to Dan Suzuki with that, Damien, just a final one from me. 2023 was less interesting to me. That's the snapback reopening year. It's 24 25. What does the glide path look like for GDP after this year?
Well, like I said, the direction of travel is lower, right? We were at 7% in 2013. We're at 5% now. If you listen to the IMF, we're at somewhere in the 4s. I mean, look, again, what I think the IMF even says is for every 1% in additional GDP growth in China, the rest of the world grows by an additional 30 basis points. So, you know, look, this is not good for the rest of the world. It's certainly not good for emerging markets writ large.
Damien, thank you, mate. And for the tee up as well. Appreciate it. It's an easy one. Dan Suzuki, you know where I'm going. You like China, don't you?
Yeah, that's right, Jonathan. I think, you know, long time, Damien, long time no speak. Yeah, absolutely. So if you think about the lens with which we view things, it always comes down to corporate profits, liquidity, and sentiment. And if you just look through that lens, you know, it's actually a pretty good outlook. Everybody knows all the problems that China's been dealing with over the past few years. They've been in a profits recession. They've had a self-inflicted regulatory issue. They've had a self-inflicted property crisis, and they have a self-inflicted zero COVID policy. All those things are well known to the markets and well discounted. Going forward, they're easing up on those things, and it looks like we're exiting a profits recession, as Damien said, just as the rest of the world is entering one. I think that's a great combination, especially if you pair it with, you know, liquidity, where they're lowering rates. They're telling their banks to lend, and nobody wants to invest in China.
Eric, non-US developed stocks, you're underweight. EM stocks, you're underweight. Are you taking the other side of this?
Well, we've actually been adding to EM stocks and gaining exposure to China through this year so far, reducing that underweight towards a neutral position. We remain underweight non-US developed, particularly Europe. We actually like Japan. I'll take the other side of Dan's position. We don't want to be overweight China right now. We want to get back towards more of a neutral position. China is a policy-driven market. It is also an incredibly inefficient market. So we want to have exposure in client portfolios, particularly to be able to take advantage of security selection in the market. But we're still cautious. So moving back towards that neutral weight and not ready to go overweight yet. We see more attractive opportunities from a growth standpoint in India, although valuations are full, and frankly in Japan, which will benefit from China's opening and has other positive dynamics, you know, strong stimulus, still a weak yen, and improving corporate governance, creating opportunities in Japan.
Dan, how would you convince Eric to do more?
Well, I think, you know, the concern that a lot of people have here is the geopolitical, right? And I think that, you know, the geopolitical tends to be overemphasized in the headlines and overpriced into valuations. That's why, you know, China trades at essentially a single-digit multiple and a half U.S. multiple here. I think if you just focus on corporate profits, which is going to be the most important driver, you know, you're going to see improving corporate profit trends for at least the next 4 quarters. And I think that, you know, when you think about the new growth forecast that came out, you know, they shouldn't be surprising to anyone. If you look at a chart, and I think Bloomberg published one, you know, earlier this morning, of all the annual targets over the last, you know, 10 or 20 years, you know, this dot fits right in line with that historical trend of, you know, slowing and moderating growth, but not falling off a cliff and not spiking up higher either. And I think that's just to be expected. But again, you got to separate out, you know, GDP from corporate profits. I think the outlook there is much more rosy.
Dan, when you say Chinese equities, can you be more specific about what you mean? Because I think for a lot of people, when they hear Chinese equities, they're thinking of these big tech names that have ADRs here in the United States. What do you mean by Chinese equities?
Well, I think, Jonathan, those areas will participate as well. I mean, if you think about, you know, the difference between U.S. tech versus Chinese tech is, you know, you have a profits recession and tightened liquidity here. Well, if you turn those on its head, you know, China is actually seeing accelerating corporate profits and improving liquidity. That's actually a pretty good environment for tech stocks as well as the broader economy. And if you look at the performance, you know, Chinese tech stocks have gotten absolutely demolished over the last few years, you know, much, much worse than what we've seen in the U.S. So I think, you know, all these things represent a better risk reward for even that part of the market. But I think it's going to be much more broad than that, Jonathan. I think if we're right in this reacceleration, this broadening out of growth in China, then all areas of the economy are going to participate. So I wouldn't want to leave any of those major components out.
Highly dependent on whether you can tolerate the prospect of regulatory risk materializing, I guess. Dan Suzuki, thank you, sir, as always, alongside Eric Knudsen. Fantastic pairing going into the opening bell. Up next on this program, the morning calls, and later, it's Europe over the United States. That's the view from Goldman Sachs' Sharon Bell. Looking forward to that conversation with European banks this year. Absolutely ripping. Equity futures right now, up 0.2%. Your opening bell, 7 minutes away.
Countdown to the opening bell is brought to you by Crypto.com, the world's fastest growing crypto app.
It's easy to get lost in investment research. Introducing JP Morgan Personal Advisors.
Hey, David.
Connect with an advisor to create your personalized
Let's
plan.
find the right investments for your goals.
Okay, great.
JP Morgan Wealth Management.
I know the markets have gone up and down, but you're right on track to reach your goals.
My Ameriprise advisor helps me feel confident about my financial future. He knows me and my goals. It's not the first uncertain environment he's helped me navigate. Probably won't be the last. But with his advice, I know I'm on track.
The plan we created can withstand uncertainty.
No wonder clients rate us 4.9 out of 5 in overall satisfaction. Because advice worth listening to is advice worth talking about.
Power E-Trade's easy-to-use tools like dynamic charting and risk-reward analysis help make trading feel effortless. And its customizable scans with social sentiment help you find and unlock opportunities in the market. E-Trade from Morgan Stanley. With powerful, easy-to-use tools, Power E-Trade makes complex trading easier. React to fast-moving markets with dynamic charting and a futures ladder that lets you place, flatten, or reverse orders so you won't miss an opportunity. E-Trade from Morgan Stanley.
Hey, I'm Cal Penn. On my new show, Getting Warmer, we're talking all things climate.
How we live is going to have to change.
I want to move beyond climate doomism and take you on a journey to discover the boldest new ideas and solutions.
If you're a politician, pass laws now. If you are a business, create options.
On our way to a carbon neutral future. This is Getting Warmer. It's a lot of Taco Bell hot sauce packets.
4 or 5 minutes away from the opening bell, looking to build on a week of gains on the S&P 500 last week. The biggest weekly gain going back to January. Futures high by 0.2% on the S&P, on the Nasdaq up by 0.4%. Let's get you some morning calls. First up, Goldman initiating coverage on Apple with a buy rating, highlighting the company's durable earnings growth and large base of loyal users. That stock is up by 1.7%. Your second call from JP Morgan, downgrading KB Home to underweight from overweight, cutting shares by 2 notches as the housing market absorbs rising mortgage rates. That stock negative 1.4%. And finally, Jefferies initiating coverage on Merck with a buy rating, seeing an attractive valuation and improving pipeline. That stock just a little bit higher. Abby mentioned it, up 0.6%. Up next on this program, Goldman's Sharon Bell making a case for value stocks in Europe, why there's opportunities in European banks. That conversation up next. Your opening bell coming up shortly.
Countdown to the opening bell is brought to you by Crypto.com, the world's fastest growing crypto app.
Only at Vanguard, you're more than just an investor. You're an owner.
You got this, babe.
That means that your dreams are ours, too. And our financial planning tools can help you reach them. That's the value of ownership.
At Morgan Stanley, old school hard work meets bold new thinking. To help you see untapped possibilities and relentlessly work with you to make them real.
We're excited to do business with you, but before we sign, I gotta ask.
Sure, anything.
We searched you online, and maybe you can explain this?
Can't believe that garbage is still coming in. That is so false.
Frustrated with your online search results? Call Reputation Defender today to join tens of thousands who've improved their online reputation. Get your free reputation report card at reputationdefender.com or call 1-877-866-8555.
Hi, this is Lisa from 4Imprint. Yes. I'd like 50 welcome wows, 300 customer I love it, and 200 team member oh yes. Certainly. You know we got some brand new woohoos.
Dial up the wow factor with promotional products from 4Imprint. We specialize in awesome items that are certain to awe and guaranteed to deliver some ooh yes. From apparel, backpacks, drinkware to high-tech items.
Wow.
I love it. Woohoo!
Go to 4imprint.com and find some wow now. 4Imprint, for certain.
From nutterly fresh nuts to ferociously yummy milk chocolate gummy bears, Nuts.com Mom has over 1,400 delicious snacks to satisfy every craving. Enjoy every flavor of happy and get free shipping on your first order.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
You are going to be told about 1,000 times over the next couple of days that you have a big week ahead, because you have a big week ahead. Chairman Powell coming up tomorrow. He'll speak again on Wednesday on Capitol Hill in his semi-annual testimony, going into payrolls on Friday, then on to CPI next week. Futures going into the opening bell to begin trading this week. Positive 0.2% on the Nasdaq, up 0.4%. Switch up the board and get to the bond market. Yields look like this, retreating from last week's high levels, cycle high. On a 2-year yield, on a 10-year yield, the highest since November, we were north of 4%. We're sub 4% now, 392.44, down about 3 basis points. On a 2-year at the front end, we retreat as well by 2 basis points to 483.38, about 11 basis points below the highs of last week. In the FX market, euro dollar 106.59, up by 0.2%. Mr. Philip Lane over at the ECB talking up more rate hikes. Maybe we talk about another 50 after this month's 50 from the ECB. And just finally, crude, just below 79.80-ish, 79.15 at the moment. We're negative 0.7% on WTI crude. About 45 seconds into the session, we are positive, just about 0.2% on the S&P. On the Nasdaq, up by 0.5%. One stock to watch at the open is Apple. Goldman initiating coverage on the stock with a buy rating, 199 price target, expecting the company's large user base to fuel growth in its services business. Abby has more. Hey, Abby.
Hey, John. Well, yeah, this is a big call because, of course, Goldman being one of the premier investment banks in the world, now making a big call on one of the premier companies in the world, the largest company in the world, in fact. But you can see over the last year, this stock has basically been stuck in a range. On the year, it's up about 18%, but over the last year, down just a little bit. So we have this new analyst in town at Goldman who is taking a more constructive view. This is their first buy rating on this stock, really, in many years, after having been on the sidelines, actually, for many years. The last buy rating 6 years ago. Now, they are positive on the mix shift. You were just talking about that user base. What it means is they might be able to diversify away from the iPhone. We've been hearing a lot about this over the last several years, more into services, which is about 20% of the business, to bring that part of the pie up. So you'd have that old legacy business, but then you could layer on the new growth. Now, the firm's $199 price target suggests about 30% upside from current levels. Since the last buy rating, this is really incredible. Apple is up 300%. The S&P 500 is up 60%. But the thing that they both have in common, clearly, are big, big gains. The S&P 500 being up 60% seems small relative to that 300% gain, but that's nothing to sneeze at all. So as much as a call as this is, John, on Apple, you could also make the case that perhaps it's also a call on the market for 2023.
Interesting point, Abby, thank you. Apple's up by about 2%. As Abby pointed out, that's the first buy recommendation on Apple from Goldman in nearly 6 years. Just to bring you a little bit more of that note, just an extra flavor of it. Apple's success in premier hardware design and resulting brand loyalty has led to a growing installed base of users, which should more than offset cyclical headwinds to product revenue. Big call from Goldman, stocks up by about 2% this morning. Another one to look at, Tesla, cutting prices on its two most expensive US vehicles for a second time in just a few months. Elon Musk saying the following at Tesla's Investor Day: "We found that even small changes in the price have a big effect on demand. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, you actually have Tesla shares down slightly on that news. They've been bouncing back and forth. We'll continue to keep an eye. But this latest round of cost cuts comes just 7 weeks after they cut costs on these models back in January. And in addition to the quote you just read, Elon Musk also said last week that demand will, quote, go crazy as the company makes its cars more affordable. So let's get into some of the numbers here. The models in questions are the Model S and the Model X. That includes the high-performance versions of those cars as well. You can see the Model S now starts at $90,000. That price tag was 6 figures coming into 2023. The basic Model X now starts at $100,000. And again, the fact that we're seeing price cuts again so soon after the latest round suggests that these models maybe got less of a sales boost from that other round of cost cuts than expected. And we know that Tesla needs to boost demand, even though Elon Musk again said last week that the desire to own Teslas was, quote, indistinguishable from infinite. Production has outpaced sales for 3 quarters. And in the fourth quarter, you can see there that Tesla made 34,000 more cars than it actually sold. And that ratio has been getting worse, John.
Katie, thanks for that. The stock's just a little bit lower. Is it a case of our sales prices, our cuts, your problem? Maybe. Dan Ives of Wedbush says this: Tesla cutting Model S and X prices, another smart strategic move by Musk and co. He says Tesla is in a position of strength on price cuts. We know Dan's bullish, so that's the bullish take on things for you right now. Here's another take. It's Morgan Stanley. They've removed Tesla as their top pick in US autos. They've replaced it with Ferrari. The analyst writing, quote, building on their learnings from hybrid and applying their racing DNA, we believe Ferrari can offer an EV that will be just as high in demand. I can't get my head around Ferraris and EVs, but that's a story for another day. Another blow for Credit Suisse. Let's talk about that bank, Beleaguer. The effort to win back clients is a struggle, and one of the bank's biggest backers, David Herro, has sold his entire stake in the lender. This is what Herro told the Financial Times over the weekend. The plan to restructure the bank is cumbersome and far more costly in terms of cash burn than we expected. We were also not satisfied with what we were getting in terms of proceeds from the sale of securitized products. Shanali's been following the story. Shanali, find me some good news for this company right now.
Listen, this is the sale that you're thinking of here, the securitized product group. These are what happens when you sell things in a down market, John. You're just not going to get what you get when you try to sell things when things are good. Now, remember, David Herro in particular has held the bull by the horns for a very, very long time. Credit Suisse never regained the former glory of the pre-2008 era. And remember, even now, he's selling at historic lows. He told the Financial Times he started selling around October when the Saudi National Bank took a stake. If you take a look now, what's interesting about the top shareholders of Credit Suisse, you are looking at a group that is largely contained in the Middle East. That is the Saudi National Bank, that is investment vehicles tied to Qatar, QIA, and now the Olion Group, with the exit of David Herro, also becomes a top 5 shareholder. So as the bank shifts towards international wealth, they now have a hefty group of Middle Eastern backers on their side. Now, I also want to take a look at a popular trade here, because more than the shares, you're looking more at the credit default swaps of Credit Suisse trading more actively, because you are looking at CDS that has widened pretty meaningfully this year. It's not at the wides that you saw early this year or even last year. It's not a meaningful risk of default you're seeing here in the bank shares in CDS, but what you're seeing is a concern among investors that is reflected by David Herro's view that it's not a risk of crashing, it is the risk of limping along. The question now with potential outflows this year is how long do they limp along for, and do they meet the new goals that they've set forth?
Just as the rest of the industry recovers in a major way across Europe. Shanali, thank you for that. And I'm talking specifically, almost exclusively, about the stock price over in Europe right now. Look at Credit Suisse year to date, now negative on the year. Look at UBS, up close to 20%. Look at the overall universe of Eurozone banks outside of Switzerland, up 24% on the Euro Stoxx 50 for the European bank names right now, year to date. And over the last year, even bigger moves than that. David Herro spoke to this in the FT. He said, rising interest rates means lots of European financials are headed in the other direction. Why go for something that is burning capital when the rest of the sector is now generating it? To discuss, Sharon Ballard, Goldman Sachs, joins us right now. Sharon, wonderful to catch up with you. I remember you said a number of months ago on this program you liked European banks. It's working out. What's great about them?
Yeah, it's been the perfect environment for European banks. You've had growth pick up in Europe. We've had higher interest rate expectations, and banks enjoy an environment really of higher interest rate expectations, increases their net interest margins. So it really has been a kind of a perfect recipe for the bank sector. And they started off with quite low valuations. The earnings season was extremely good, both the third quarter one, but the fourth quarter one was really above expectations. So it's absolutely been perfect for the European banks.
Sharon, we've had this story of a valuation gap between Europe and the United States beyond the banks at the index level for quite a while. It was a valuation trap for quite a while. I take from your stance, Sharon, you think that's really changing, that valuation gap is not warranted or deserved. And I was going through your work and you said you were looking across utilities, staples, energy and banks. What do you see there across those four areas?
Yeah, there are quite a few sectors in Europe. So first of all, I would say, yes, there is a big gap between US and European valuation. Do I think it should close entirely and Europe should trade on the same PE multiple as the US? Absolutely not. The US has higher growth companies. It has a much bigger tech sector that tends to attract a higher valuation. So I wouldn't expect it to disappear. But yes, every single sector in Europe trades on a discount to its peer sector in the US, and that discount is generally quite big versus the past. Consumer staples, which perhaps aren't in fashion at the moment, they're a defensive area and growth is improving a little bit, but they trade on a big discount in Europe relative to similar names in the US. The energy sector is one of the ones with the biggest gap, though. You mentioned that sector. It trades on a much lower multiple in Europe than it does for its counterparts in the US. And really, they're in a very similar business. So we do think the gap should close a little bit for quite a few different sectors.
Sharon, just on energy specifically, can you explain that valuation gap because of a windfall tax, a regulatory push in Europe that maybe doesn't exist here in the United States? Does that explain it?
Yeah, so there's a little bit of that. I mean, bear in mind that the companies in Europe, the large European energy majors, make their profits globally, and they will pay their windfall taxes where they make the profits. So some of these windfall taxes will be put on US companies that also make money in Europe and elsewhere. So yes, I think a little bit for the windfall tax risk and imposition. I think also quite a bit for the fact that ESG funds tend to have very low weights if they invest at all in the big energy majors in Europe. Whereas obviously those funds have grown everywhere, but particularly in Europe. So I think those are the factors that keep European energy stocks at a big discount. But in terms of who wants to buy energy stocks at the moment in Europe, actually you don't really need a buyer outside of the sector itself. The energy sector is buying back shares. So we've seen huge buybacks in the last year. I expect them to continue this year. They're the biggest buyer at the moment of energy stocks.
Sharon, for a long time we talk about the index level, Europe versus the United States, and the easy explanation for the discount was just the sector mix that existed in the United States, much heavier in terms of tech, which explained that valuation premium. Sharon, do you think then, looking at the sectors, adjusting for that it goes beyond that?
It absolutely do. So every sector in Europe is on a discount to its US sector. So even if you do put them on the same weights, use perhaps global sector weights to weight up the valuation of US sectors, do the same for Europe, you still get a big gap. You can perhaps close about a third of the gap difference between the US and Europe, just putting them on the same sector weights, but still 2/3 remains. Some of that's Europe's typical discount to the US, and I understand why Europe should be on a bit of a discount. Lower growth economically in Europe, perhaps a little bit more sovereign risk in Europe. But the discount at the moment is particularly large, and it's true across lots of different sectors. And tech is a good example. There's a discount for Europe, a very small one between European tech and US tech. But actually in the next couple of years, based on the consensus, European tech has a better growth forecast than US. So should it really trade on that type of discount still?
Interesting. That's what I wanted to talk about, just to finish on it. The next year or so. So Sharon, year to date, great call. It's materialised. I can see the moves. France earlier this morning, another record intraday. CAC 40 year to date up 14%. Germany up 12%. Spain up 15%. Italy up almost 18% year to date. There might be some people who weren't in this trade, Sharon, that saw that and just thought, okay, I've missed it. I don't want to go there. What do you say back to them?
Yeah, I think Europe can outperform the US, but I wouldn't expect super strong returns from here for either side of the Atlantic. I think the problem is we've already priced in a lot of sort of the potential improvement in growth. We've already priced in a lot of that. And of course, interest rates are rising. Those sort of rising interest rates expectations mean there's another asset class you could potentially invest in and get a risk-free or close to risk-free return in bonds, sovereign debt, in cash even. So I think the attractiveness of equities relative to those has come down a bit given the performance. But having said all of that, I do think Europe looks cheap versus the US. You still get a good income and dividend from Europe. You're still kicking off quite a lot of cash. The companies are buying back shares. And European growth has improved quite a bit. So all of those things mean Europe probably outweighs the US in terms of sort of investor returns for this year, in my view.
Just massive moves already year to date. Sharon, thank you as always. Sharon Bow there of Goldman Sachs on the European story and the outperformance we're seeing in Europe year to date so far. Higher rates helping out the big banks. At some point, even higher rates become a problem. I have no idea how far or how close we are to that moment. The S&P 500 positive 0.4%, about 13 minutes into the session. The Nasdaq up by 0.5%. Coming up next, US lawmakers taking aim at tech in China.
In terms of foreign technology coming into America, we've got to have a systemic approach to make sure that we can ban or prohibit it when necessary.
That conversation still ahead.
The Opening Bell is brought to you by Crypto.com, the world's fastest growing crypto app.
Who would you say is the author, you or the AI?
We're seeing a rise of synthetic media, deepfakes, image filters, that kind of thing. It's becoming increasingly difficult to tell a video file which has had somebody else's face deepfaked into it. And so we got to ask ourselves, are we the author of that?
Hyundai Motor, connecting art and technology.
What happens when uncertainty is less uncertain? Essential intelligence from S&P Global empowers you with the information and guidance to easily navigate potential risk. Because when you have the tools to do more than simply manage risk, there's no opportunity you can't seize. A better future awaits. It's yours for the seeking. S&P Global. Seek and prosper.
Introducing the new Maraba, the world's largest modern downtown, and at its heart, the Macabre, the world's first immersive experiential destination. Step inside and it's unlike anything you've ever seen, at a scale that's unprecedented. This is the new face of Riyadh, a gateway to another world, New Maraba.
For businesses of all sizes, there are a lot of choices when it comes to your internet and technology needs. When you choose Comcast Business Internet, you choose the largest, fastest, reliable network. You choose advanced security for total peace of mind. And you choose a next-generation 10G network that's always improving, getting faster, more reliable, and more intelligent to keep you ready for today and tomorrow. The choice is clear. Make your business future-ready with the network from the most innovative company, Comcast Business, powering possibilities.
At CDW, we get your team's work in different places, in different ways, and across countless different networks. So how do you get everyone on the same page? Microsoft Surface devices, orchestrated by CDW. They adapt to each user and deliver multi-layered security, so your workforce gets seamless experiences wherever they roam. For devices that fit your unique workforce, trust Microsoft Surface and IT orchestration by CDW. People who get it.
Think he's posting about all that ancient Roman coinage? No. He's making real-time money moves with Merrill. So no matter what the market's doing, he's ready. And that's how you collect coins.
Your money never stops working for you with Merrill, a Bank of America company.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, an exclusive interview with J.P. Morgan Chairman and CEO Jamie Dimon. That's at 11:40 a.m. in New York, 4:40 in London. This is Bloomberg.
In terms of foreign technology coming into America, we've got to have a systemic approach to make sure that we can ban or prohibit it when necessary. We've got 100 million Americans on TikTok 90 minutes a day. They are taking data from Americans, not keeping it safe. But what worries me more with TikTok is that this can be a propaganda tool
US lawmakers stepping up the push to ban TikTok. President Biden closing in on an executive order to restrict US investments in China tech. The administration writing in a report seen by Bloomberg that the objective is, quote, preventing US capital and expertise from being exploited in ways that threaten US national security while not placing an undue burden on US investors and businesses. Team coverage starts right now with Bloomberg's Anne-Marie and Kelly Lyons down in DC. AMH, talk to us about what's on the table here.
Well, Jonathan, you just see Washington continue to address the Chinese Communist Party and adding more tools to their toolbox. One comes from the White House and the other is from the other side of Pennsylvania, coming from lawmakers. So first you have the White House. This is really a long time coming. Reports for months about this executive order. But what would it do is restrict investment into certain parts of the Chinese economy. These parts, the administration think that this advanced technology that this investment would go to could enhance either the Chinese Communist Party military or as well as their intelligence capabilities. And we may get more details about it today because Biden will be unveiling his budget on Thursday, this week. Then the second part of this is just another bill that either it names TikTok or not, it will go after TikTok. You have Senator Warner on Fox News on Sunday saying that this has broad bipartisan support. He's working with South Dakota Senator John Thune, and this would basically ban this kind of technology in the United States. But this has to be the 6th or 7th bill that is going after TikTok. So at some point, one of these, you imagine, is going to get across the finish line.
Well, I just wonder how narrow this might be. Anne-Marie, just reading that language, technologies that could enhance China's military and intelligence capabilities. Based on what they've been saying, is TikTok part of that?
Well, that's a great question. If you think about intelligence capabilities, TikTok could potentially be part of that because many view it as the Chinese Communist Party is able to, because TikTok is owned by ByteDance, a Chinese company, is able to gather intel and data on these users in America. But we should note, Jonathan, and at the end of the month, the TikTok CEO will be in Congress. He will have a hearing and he will be testifying. They are spending billions of dollars really on this project called Project Texas. They're working with Oracle. What they want to do is make sure they can show CFIUS, U.S. lawmakers that there's a way that they could still remain active in the U.S. and keep the U.S. data safe in the United States. And they're working with the European Union as well for something similar in Europe.
And Katie, two words here that stand out: capital, expertise. That's not just money, that's talent too.
Yeah, exactly, John. But the money, of course, is ultimately a good deal of what matters to the markets. And when you talk about technologies that could limit the advanced military and intelligence capabilities of China, this could reach into a lot of different areas of Chinese technology, including chips and chip makers, makers of manufacturing equipment, anything related to AI and ChatGPT and quantum computing as well. So as a result, you are seeing this show up in the ADRs of some of those companies, the likes of Alibaba and Baidu, BDD, all down this morning, even about 2% in the case of Baidu and PDD. And when you look at the Golden Dragon China Index, which of course tracks a basket of those stocks, it is down about 1.3%. All of these, of course, listed here in the U.S. John, we had seen years ago a big boom in IPOs of Chinese technology companies here stateside. Alibaba, of course, back in 2014. That has started to trickle off. In 2022, there was only about $500 million worth of IPOs here. It has gotten a lot more difficult due to the headwinds around geopolitics and, of course, a lot of questions around auditing as well. This now would add another layer on that investment difficulty and adds another layer, perhaps, of difficulty for these stocks because we know, John, over the last several years, these have been underperformers. Yes, the Golden Dragon China Index is up about 70% from its low back in October, but still over the last 2 years, it's down roughly 57%. And Chinese stocks as a basket dramatically underperforming the rest of the world, down about 40% over that time compared to the All-Country World Index, down just about 2.3%, John.
Wow. AMH, I just want to give you the final word. Away from the equity market just for a moment, just on the politics. We heard from the former President Donald Trump over the weekend campaigning. We heard from the governor of Florida, I won't say campaigning, but certainly on the media tour still, ahead of potentially announcing he's going to make a run. Is China going to be a big feature of this upcoming election in 18 months' time?
Well, it absolutely is. What did you see this morning with the Daily Mail? An opinion piece from the former President Trump talking about COVID and how he wanted to go after the World Health Organization because he thought they were deferential to China in the beginning of this, because also we've had recent reporting coming from the Department of Energy that they say this was a lab leak potentially. So, Jonathan, China, whether or not it's COVID, whether or not it's investment, whether or not it's the data, many lawmakers say they are harvesting in this quote-unquote Trojan horse in the United States through TikTok. China will become this #1 enemy for lawmakers, not just in the GOP, though. This is going to be as well for President Biden, who's expected to make his campaign as well. He's going to show all that he's done while he was in power to try to make sure that they are competing with China and keeping American data and money safe.
MH outside the White House, thank you. Kelly Lyons down in D.C., thanks to you too. Big story over the next 18 months, that's for sure, potentially anyway. Into the equity market, 23 minutes in, we are positive by 1/3 of 1%. Let's get you some sector price action. Here's Abby.
Yeah, John, and that is the first 3-day upswing for the S&P 500 that we've seen in more than a month, the most that we've seen the S&P 500. So not surprisingly, we're looking at bullish sector action. Tech really helped out by Apple. We also have some of the other mega caps following along, communication services. And just to tie the bow on the bullish year so far, take a look at technology, the best sector, the 3 down sectors this year, John, they're all defensive.
Abby, thanks for that. Up next, your trading diary.
The Principal Room, brought to you by Principal Asset Management. Specialized expertise, unique perspectives, optimized results. Principal Asset Management, actively invested. Learn more at principalam.com.
Taking an active approach to investing means looking at asset management through a different lens, one with a clear focus on our clients. Throughout market cycles, teams of specialists at Principal Asset Management have applied local insights and global perspectives to optimize results. This clear point of view allows us to identify the most compelling opportunities now, while positioning for what's next. Principal Asset Management, actively invested.
What if you were a global bank who wanted to supercharge your audit system? So you tap IBM to unsilo your data and start crunching a year's worth of transactions against thousands of compliance controls with the help of AI. Now you're making smarter decisions faster, operating costs are lower, and everyone, from your auditors to your bankers, feels like $1 million. Let's create smarter ways of putting your data to work. IBM, let's create.
You'll always remember buying your first car. But the things that last a lifetime, like happiness, love, and confidence, you can't buy those, but you can invest in them. At T. Rowe Price, our strategic investing approach can help you build the future you imagine.
What do you see on the horizon? Uncertainty or opportunity? Whatever you see, at PGIM, we can help you rise to the challenges of today, when active investing and disciplined risk management are needed most. Drawing on deep expertise across the world's public and private markets in pursuit of long-term returns. PGIM, our investments shape tomorrow, today.
Almost 26 minutes into the session this morning. Good morning to you. Equities broadly positive by 0.4% on the S&P, on the Nasdaq up 0.6%. Let's get you to the trading diary, what you need to be looking for. Top of the hour, US factory orders and durable goods. On Tuesday, Fed Chair Jay Powell kicks off 2 days of testimony on Capitol Hill. ADP numbers, monthly jobs report coming up on Wednesday. President Biden releasing his budget proposal on Thursday. And finally, the big one on Friday, the payrolls report to round out the week. A sneak peek of our survey, a moving target, but a median estimate so far, 223,000 for Friday's payrolls. From New York, this was the countdown to the open. This is Bloomberg.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
you.